Welcome to Yahoo Finance Live. I'm Julie Hyman with Inez Ferre. We are breaking those December CPI numbers right now. We saw a drop of 0.1% in the month-over-month headline consumer price index. If you look at the core number month over month, you get an increase of 0.3%. So that is not representing any kind of deceleration. In fact, that is a little bit, a 10 percentage point of acceleration from the prior month in the core number. Year over year, CPI rising 6.5% on a headline basis. If you back out food and energy, you get a 5.7% gain on a year over year basis. So obviously these numbers very, very closely watched by the market here. The market probably going to key on that core number rather than a headline number, because that is the one that the Fed is paying attention to, Inez. So the read, at least for me, it looks like that these numbers are pretty much in line with what economists had been estimating.
Yeah, pretty much in line with what they had been expecting. And taking a look at this report and just looking under the hood a little bit at some of the sectors that we've been watching, the index for gasoline, by far the largest contributor to the monthly, all items decrease, more than offsetting increase in shelter indexes. So gasoline, energy, we know that energy prices were down, especially in the first 2 months of December. You saw oil dipping. So that would have an impact on this read. But certainly the core number is what we've been also watching, and services is something that we've been watching. Services minus shelter is something that Jerome Powell has talked about, because those services are so linked to wages. And by that, we're talking about education, we're talking about even haircuts, hospitality. That's something that certainly the Fed's going to be watching.
Yeah, so I would say the big picture takeaway from this is this does not change the Federal Reserve's trajectory, right? It does not allow the Fed to be more dovish, to be less hawkish, to stop raising interest rates, to decrease the amount of interest rate increases at this time. And just breaking down a little bit more some of the individual components, you were just talking about services here, and I'm seeing services less energy services still up 0.5% last month. Shelter still up 0.8% last month, which was actually a reacceleration from the November increase. Transportation services up 0.2%, and medical care services up 0.1%. Both of those measures had fallen in November. So no reassuring news there, at least at first glance in those numbers.
No, and if we also take a look at food on a year-to-year basis is up 10.4%, month over month up 0.3%. That's something that we've also been watching. And as we had mentioned, energy up 7.3% year over year, on a month over month, down 4.5%. But look, Julie, as you were mentioning, the trajectory of the Fed and what the Fed is going to be doing, this is what the market's watching in this report. So if this number were to have come out a little bit cooler than expected, then the markets could expect that the Fed may ease a bit when it comes to the rate hikes. What the market has been expecting is anywhere between a 25 to 50 basis point rate hike in the next meeting, and it looks like that could be on the table.
Yeah, let's take a look at the Yahoo Finance Interactive real quickly, because I want to show on an intraday basis what we're seeing in the futures. And so we did see a climb into the numbers and now a come down here as we're not seeing any relief. Perhaps the hopes were that this number would look a little bit better. Who knows? I'm also looking at the Treasury futures here. Now, remember, when this moves inversely to prices, or yields, price and yield move inversely. And so we saw the price starting to move off ahead of this, now coming back up a little bit, but when all is said and done, there's not a big movement, it looks like, in those bond yields.
No, and we're just taking a look at the U.S. dollar index. That's what I watch quite a bit to see where equities are going to be for that day. That's just below 103. It's ticking a little bit higher right now, as we can see right here. So this is certainly will be impacting equities today.
Yeah, but let's just quickly recap the numbers overall as well. Bang in line with economists' estimates is where we're seeing these CPI numbers month over month, a drop of 0.1%. However, the core number, excluding food and energy, still up by 0.3%. That does it for us. I'll be back at 9 with much more coverage. Inez will be along as well. Shares of Bed Bath & Beyond are taking off as potential bankruptcy looms and speculation of a takeover makes the rounds. Volatility in the meme stock name over the past year made shorting Bed Bath & Beyond a lucrative trade. But what does the short interest picture look like now for the company? For this and more, we have Ihor Dusanowski, S3 Partners Head of Predictive Analytics. Ihor, good to see you. Always good to catch up with you and the great data that you guys provide. So talk to us about Bed Bath & Beyond. Now we've seen it bouncing for a few days. Has some of the short interest in this name been sort of worked out here?
You know, this has been a big short for a long time, and it's really been a really busy short since it hit its recent highs in late March. We saw 25 million shares shorted since then, and another 3.6 million shares shorted in 2023. So shorts aren't going anywhere, and it's one of the bigger, more crowded shorts in the market right now.
Is any type of short covering the kind of event that would really lead a concerted rally next from here?
You know, it's really interesting because we're looking at possibly a bankruptcy stock. So most short sellers are going to hold on. You know, if I got a chance for the stock to go down to zero, I'm going to wait for it to go down to zero. That's what they're thinking. What we're also seeing is that while short selling and short interest on the institutional side has gone up by around 2/3 over the past year and change, institutional long holding has gone down by around 2/3. So this is really a retail stock. We've got our Black app, which is kind of looks at the long side of the market now, and it's showing that active and passive shareholders went from 140 million to only 40 million shares held long. So this is going to be a really volatile stock.
Ihor, how long do you think the short squeeze in Bed Bath can continue? For the average investor out there trading almost a $3 stock, what signs should they be looking for?
Well, this is an expensive stock to borrow. We're talking about new shares to borrow to cover your short sales going at around 40%. So it's eating your profits up every single day. We're going to see, short sellers hold on for a little while longer until, the market kind of pops up a little bit. But yeah, I don't see the shorts leaving the stock anytime soon.
Ihor, I want to move on to some of the other stocks that you track as well, including the likes of Tesla, which was also enormously shorted last year. Do we see anything different this year? And I also wonder, the calendar is a construct, et cetera, but do we tend to see a clearing of the decks with short interest when we head into a new year?
For some of these big names, it's the name you love is the name you stay in. Shorts have made we're down $15.8 billion in mark-to-market losses in Tesla last year. So you would think that most of these guys got out of their trade, but not so much. We've still seen short selling go up in the name, and because the stock price keeps going down, and short sellers made $15.8 billion last year, and we're still seeing people shorting the name. Of course, they lost $40 billion since 2010, so they get a lot to catch up.
This, for Tesla, it's really the second largest short, just behind, as our viewers are seeing there on the screen, behind Apple and Microsoft, or just ahead Microsoft. With all of that in mind, for two of the larger tech companies out there, for Apple to have the amount of shorts that it does, what does that indicate to you about the sentiment around even big tech or mega cap tech, given that it's fallen so far because of the broader market declines, and along with, rather, the broader market declines that we'd seen in 2022? And what would it take for that to reverse course?
Yeah, Apple is an interesting short, but it's not only a fundamental short on the stock because people are worried about the China exposure and demand for the new iPhones. It's also a short to hedge technical long exposure. So if I'm long a big block of technical stock in my portfolio, I could either short using one of the ETFs or some futures, but it's much easier for me to short Apple and have a short that covers some of my long exposure on the long side in one simple name. So a lot of that is hedging short selling.
Bigger picture here, if at some point soon we do get a sign of a Fed pivot from the Federal Reserve, what does that mean for the short selling community?
December saw a tremendous amount of short selling, over $90 billion worth of new short selling just in December alone. January slowed down a little bit. We see around $10 billion worth of short selling right now. If this market turns around, you're going to see a lot of these shorts that put on recently just start covering their positions. So you're going to see a little bit of turbocharge to the rally if the short sellers start buying to cover. So let's wait for the market to go up a little bit. Shorts get a little skittish, and then they're going to start covering because they want to realize some of their gains that they had in 2022 and not blow them up in 2023 if the market rallies.
Interesting. We'll see, though, if any kind of rally can be sustained. Ihor Dusanowski, always good to talk to you. S3 Partners Head of Predictive Analytics. Thanks.
Thanks for having me back. Take care.
The public reasonably expects supervisors to require that banks understand and can appropriately manage their material risks, including the financial risks of climate change. But without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools, for example, to promote a greener economy or to achieve other climate-based goals. We are not, and we will not be, a climate policy maker.
That was Fed Chair Jerome Powell there yesterday with remarks on the Fed's clear role in regards to climate change, a blow to environmental activists who have pushed central banks to take steps to restrict lending to energy companies. All this as ESG funds took a hit the past year with no relief in sight. For more on the road ahead for ESG, we have to discuss with us Bill Davis, Stance Capital founding partner and portfolio manager. Thank you for joining me this morning. So obviously we've seen some of these ESG funds especially getting beaten up. In fact, 10 of the largest ESG funds by assets over the past year underperformed the S&P. I believe only 8 underperformed the S&P. But how hard of a sell is this right now, investing in ESG?
Well, first, Rochelle, thanks for having me on. I think I don't think it's a hard sell at all. I mean, to be sure, I think the industry faces some headwinds, some of which I think are a little bit self-inflicted. For example, if you think about the S&P 500, it's a market cap weighted index. I think entering 2022, 6 or 7 companies accounted for 25% of the index. I think now with declines in a lot of FANG stocks, that's down to maybe 10 companies accounting for that. But, you know, because it's mega cap concentrated and because you had stocks like Apple down, I think 27% last year, Amazon 50%, Microsoft 29%, and all the rest of the FANG stocks kind of were averaged, I think they averaged 50% declines. It's not surprising to see a lot of US ESG managers who happen to be growth oriented taking a big hit because they're simply overweight a sector of the economy that, you know, disproportionately underperformed in 2022. So I think that is part of what has happened, and that's a big part of what's happened. I think that's also part of the challenge moving forward, because in a rising rate environment, I don't think growth stocks is necessarily the place that a lot of investors want to be making big bets right now. And that is kind of, sort of self-inflicted headwinds. I think that there is a second set of headwinds that really is not a grassroots initiative. It's basically, frankly, a political ploy funded by a web of dark money or a network of dark money funders that is seeking to kind of make ESG or values-aligned investing a political wedge issue. I think it's doomed to fail for a variety of reasons.
And so to that point, then, obviously, it has become something of a political football, some critics accusing it of being woke investing if you invest in ESG. Do you expect that to perhaps get worse now that you have a Republican-controlled House? How do you expect that, especially the policy surrounding it, to continue?
I think it's mostly a bunch of noise. I mean, interestingly, most Americans don't have any idea what ESG is. Most Americans, by the way, aren't stock market investors. But the more they get educated that this is really a means of managing risk, and the idea that capitalism is going to be sustainable in order to continue to be capitalism, I think that you're going to find that, number one, the more talk there is, the more confusion there is. And secondly, the more people do get to understand what's actually going on, the more they're going to want to sign up for it. So I don't actually think that the political headwinds are going to amount to much other than just simply a lot of noise.
And as you look at the demographics, you are seeing that younger investors in particular prioritizing some of this ESG investing. What sort of returns, though, can we expect then in 2023?
Well, before we get to young people as investors, they're also employees, right? So something like 60% of the US workforce is going to be made up by millennials and Gen Zers, I think as early as 2025, so 3 years from now. These employees are also consumers, and what they want is they want sustainability. They are for things like diversity, inclusion, and social equity. This is what they want. So this idea that companies are being led around by the BlackRocks of the world is really completely missing the point that out of enlightened self-interest, many major corporations have recognized that this is really good for business. And, climate risk is an existential systemic risk that's going to affect all businesses and it's going to affect all of humanity. And so from a fund management perspective, being on the right side of that story and investing in companies who are doing a better job of mitigating these risks is important to younger investors, but it's becoming more important to all investors, whether they're big institutions or smaller companies. And just to add something to what you said about the performance of the industry as a whole, in 2022, Stance Capital actually outperformed the S&P on a gross basis by over 600 basis points. We now have a 9-year track record in our U.S. large cap strategy, which includes over 200 basis points of annualized outperformance with less risk. So the point is that if ESG is done properly, it actually minimizes risk and invests in companies who are better positioned to weather climate-related storms in a figurative sense, but I suppose a literal sense too. And it actually positions, I think, companies to be on the right side of history with employees and other stakeholders.
Definitely keeping in mind that stance, ESG that we're taking a look at there. A big thank you to Bill Davis there, Stance Capital founding partner and portfolio manager, for joining us this morning. All right, let's now turn to a wider look at the tech space. The sector could be nearing the end of its COVID-induced overextension hangover and might be looking to return to performance-driven positive trends. Joining us with more is Erica Clower, Technology Equity Portfolio Manager at Jennison Associates. Good to see you, Erica. So in terms of this hangover, because of COVID, because of constrained supply chains, as we sort of see these things the wrinkles start to come out, what are you looking at in terms of your expectations for this year?
Well, thanks for having me. At Jennison, we are, I would say, cautiously optimistic. We've made our way through a lot of difficult times coming through this COVID hangover, as you mentioned. We've also seen a lot of bubbles pop with regards to things like NFTs, cryptocurrencies. Many of the valuations of the highest priced technology companies have come in significantly. So we've made our way through a lot of difficulties, and estimates have come down to more reasonable expectations. At the same time, there are still some near-term headwinds associated with things like the strong dollar and also some of the regulatory problems that we are facing with regards to shipping products to China and strained relationships with that country. Having said all of this, at Jennison, we're really looking out over the next 3 to 5 years, and we see many different large vertical markets that are still in very early innings of growth, things like 5G, autonomous driving, artificial intelligence, that we think are going to push the technology sector higher.
So let's break some of that down. Let's start with, say, the likes of Apple, bringing more of their development and design in-house. Can we expect those sort of moves as really sort of after that wake-up call about perhaps diversifying some of their supply chains when we did see the lockdowns in China and a lot of companies were like, well, what do we do now?
I think we will continue to see companies diversifying their supply chain to reduce their dependence on one single source supplier. And so for those companies that are supplying some commodities, I think that the environment will be more difficult. However, for those companies that have sole source, large barriers to entry to compete with their products, I think those companies will relatively be better positioned. Fortunately, many of those companies are US based, whether they're software companies or hardware companies. There's a lot to choose from.
I also want to talk to you. You mentioned EVs there. Obviously, Tesla has some of its own issues given what's happened with Elon Musk and Twitter. But then as we look at the performance of EVs, what do you like in that space? And which ones do you think are going to be struggling this year?
So our team at Jennison really looks to the early innings of electric vehicle adoption. And so we think that there's a long runway for growth. And I think that what we're really looking for is more the components within the electric vehicles, the semiconductors, the software suppliers that can really enable the next generation of electric vehicles and also autonomous vehicles. And at the top of that list is NVIDIA. NVIDIA's stock has come down quite a bit from its high. It's rebounded a bit as people are looking towards its dominance, not only in the artificial intelligence area, but its newer entry into enabling autonomous vehicles themselves.
And you mentioned a couple of multi-billion areas of opportunity. You mentioned autonomous driving, robotics, vehicle electrification, artificial intelligence, but also healthcare as you look longer term as well. What do you like there?
So healthcare is such an interesting area for us here. You know, our team at Jennison is really looking at things like the aging population and how we can service a aging population, not only in terms of within the doctor network and the hospital network, but also home health care. So digital health is something that interests us quite a bit. Companies that are enabling remote health monitoring are very, very interesting to us right now. And then, of course, within the hospital itself, robotics are coming more and more into play and providing patients with very effective treatments with a little more, with fewer human error factors.
And obviously, as these innovations continue to grow, you're going to need people working in these industries, but we're also at the same time seeing deglobalization. How is that going to impact sort of the pace of innovation and what this means for some of these tech stocks?
So that's a great question. The deglobalization is probably, in my opinion, the biggest risk to the technology sector in the short and medium term, because companies are having to not only look at their supply chain and figure out that perhaps the one area where they were manufacturing, which was the lowest cost region for them, is just not a risk properly adjusted strategy. So companies are duplicating their manufacturing efforts. And by definition, that is inflationary, and it also is disruptive. Also, at the same time of deglobalization, we're seeing many more signs, particularly in China, of companies wanting to in-source, just like Apple is, more and more of their own products from domestic suppliers, from Chinese suppliers. So those are areas that are inflationary by nature, the pressure margins in the short and the medium term. So that's something that we have a very close eye to, and I think is something that's definitely worth watching.
And we certainly don't hear enough about that. So I'm glad you highlighted that. Erica Clower there, Technology Equity Portfolio Manager at Jennison Associates. Thanks so much.
Good morning. It is Thursday, January 12th here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brian Sozzi. Brad Smith's on assignment today. Let's get right to the market action after the latest CPI print. It was bang in line with what economists were expecting, down 0.1% in December. The core number up 0.3%. Both of them are what economists were looking for. If you look at this stock reaction here, initially there was actually a dip in S&P futures in the wake of the number. Perhaps a little bit of hope here that we were going to see a little bit more relief on the inflation front. That did not materialize, but now we are seeing futures go back higher. I'm also watching Treasury futures here this morning. We are seeing prices there go higher. That means the yields are going lower. So interesting here, even though inflation is not decelerating, at least judging by this number and the month-over-month core print, we are still seeing bond yields come down a little bit here, Saz. Quite an interesting reaction.
Always interesting stuff. All right, Julie, let's get more into these numbers. Inflation December rose 6.5% year over year, its slowest annual increase since October 2021. Let's bring in Yahoo Finance Fed correspondent Jennifer Schonberger for more on what this report might mean for the Fed and what it might not mean. Jen.
Good morning to you, Brian. Inflation, headline inflation, I should say, slowing down for the third month in a row in December, though still remaining high overall. If you look at the consumer price index, that fell, as you just noted, by 0.1% last month, though rising 6.5% year over year. That's right in line with estimates. The big driver of that, a slowdown and drop in gas prices, which offset housing prices. But if you strip out those volatile energy and food prices to get that so-called core number that the Fed looks at, core rose 0.3% in December after rising 0.2 in November, so inching up a bit month over month. Year over year, CPI up 5.7%, in line with estimates, both of these, and down from the 6% seen in November. Now, the cost of shelter, that's rent and homes prices that we pay, that was the main driver of core CPI. And shelter rose a hefty 7.4% last month, the rent index rising 0.8% over the month. Now, the key metric, the one that the Fed is focusing on in this report, is services inflation excluding housing. That rose 0.4% month over month and 7.4% year over year. So that is still quite sticky. If we zoom back out, inflation clearly slowing down last month and over October and November. So now we've got a full quarter where inflation seems to be slowing down, perhaps underscoring that the Fed's rate hikes are starting to work to slow down inflation. And this could help the Fed feel a bit more comfortable and perhaps moving by 25 basis points at its February 1st policy meeting versus 50 basis points. But it would still likely be that they expect the Fed funds rate to peak above 5% as was projected back in December. Now, we are getting some comments just 15 minutes ago from Philadelphia Fed President Harker, who was speaking in Pennsylvania this morning. And he says that those eye-popping numbers on inflation that we saw in 2022 are likely in the rearview mirror, and that moving ahead, 25 basis point interest rate hikes would likely be appropriate. Now, these comments were prepared before the CPI report, so take that as you may, but at least one member of the Fed, the Philadelphia Fed, is saying that he thinks 25 basis point rate hikes makes sense going forward. Back to you.
We shall see. Let's dive more into the inflation print. Thank you, Jen, and what this means for the markets and the economy. We've got Sanctuary Wealth Chief Investment Strategist Marianne Bartels and JP Morgan Senior Economist Stephanie Roth here with me on set. Thank you both for being here. Appreciate it. So looking at these numbers, has the Fed done enough? I mean, if you look at the components that fell the most, it was energy prices, which the Fed doesn't have anything to do with, really. So what's your read on this report?
I think we can say that inflation has peaked, but the level of inflation is nowhere near where the Fed wants to be. So they're going to continue to tighten a little bit. And they've been very clear on their message, is that they want to get up to around 5%, maybe a little bit higher, and stay there for the rest of the year. I found it very interesting that no one on the Fed FOMC, is forecasting a rate cut this year, although the market is forecasting the rate cut. So I think they're going to try to stay as tight as long as they possibly can, because the last thing they want to do is make a mistake and ease too quickly. When you go back to Jackson Hole, Powell said in his statement they were going to keep at it. And I think that was a clear message that he's going to follow the Volcker path. He wants to squash inflation.
Stephanie, we're always looking at this through the prism of the markets, what it might mean to the Fed and various stocks. What does it mean to the average household? Because I know inflation slowed down month over month. That is a good thing. But egg price is still up 11% year over year. Rent price is up. Are these still the type of inflationary numbers that would put the U.S. economy into a consumer-driven recession?
Yeah, it certainly is a challenge for the consumer. And I would say even the bigger concern is the outlook, in that with the Fed hiking up to 5% and staying there for a year, it's likely to cause a recession, which is going to be a challenge for consumers, because recession likely means layoffs. So people might ultimately lose their job as a result. But the Fed is fighting inflation from the top side. They don't want to worry about inflation getting out of control, so they're likely to stay tighter for longer. And the print that we saw today is consistent with the Fed continuing to hike, even if they do step down to 25 basis points. So a Fed that remains tight for this long is likely to put downward pressure on the economy, and the consumer is likely to feel it in a different kind of way, not just from a price pressure perspective, but now from the perspective that they might start losing their jobs, which is a very challenging outlook.
Yeah, Saz is always very focused on the egg prices that continue
to
go
be, Julie.
up
Have
and
to be.
up and up. But it's avian flu, which the Fed can't.
We all eat
there's
them.
only so
We
much
all
the
eat
Fed
them,
can do
Julie.
about that. I want to talk about the market reaction a little bit that we're seeing this morning, because it is interesting that we are seeing stock futures now higher. Did anything change in the outlook from this report, in your view, and why are we seeing stocks react like this, Marianne?
I don't think that there's anything changed. I think this is very technical in nature. In December, the market sold off. We got very oversold technical readings. I think we're working off those oversold. I think as the S&P approaches 4,000 up near the 200-day moving average, I think there's risk that we still go down. I still believe we're in a bear market. The risk is we're still going to come down and test those October lows. And the big question is, will we hold those October lows? And I think a big component that will help us determine that is we're moving into earnings season. The big day is tomorrow with the banks reporting, is where are we in earnings? Because the top-down strategists have taken down their numbers. Bottom-up analysts have not really taken down their numbers. They're looking for earnings to actually increase 5.5% for the S&P. So I think it's going to be very important to listen to the CEOs about what their outlook is for their business for 2023. And we might see adjustments in earnings. But what we've been telling our clients, as long as the Fed is raising rates, that's going to cause volatility in both the equity market and the bond market. And then if you still have to take the numbers down for the S&P, that's also going to create volatility. But we do see a bull running, and no one is talking about where the bull is running.
Oh, well, that's a big
Marianne,
tease. Hey, go ahead, Saz.
Right, Marianne, let me just follow up on that, because what should investors pay attention more now to? What the Fed may or may not put out into the market in terms of language and policy, or is it this earnings season, which kicks off tomorrow with the banks and may not be too good, like you mentioned?
Well, I think the Fed has been very clear on their policy. They're going to stay as tight as much as possible for as long as possible. So I think that message is very clear. I don't think the earnings picture is clear. And I think we really have to pay attention to earnings. But what's very interesting about the market is you have a bear market in a pocket of stocks, and you have a bull market already in another pocket of stocks. And the reason why we're not seeing the bull is their market cap is too low. So even though they're rising, and many of these stocks are hitting record all-time highs, the decline in the growth stocks is too much. It's outweighing what's happening in the value side. And the easy way to look at this, energy, we think, is part of this new bull run. And energy only represents 5% of the S&P, where Apple, which is part of the growth names, and it's a great company, but expensive, business is shifting, and that represents 6% of the market. So there's a big difference in terms of where the bear is, and the bear has a lot of market cap, it's growth, it's tech, it's FANG, what we're doing is we're repricing those stocks on a PE basis. They just got expensive. You've got to deflate them down. Market is shifting to value. That's where the new bull is, but we just don't see it because their market cap is just not able to compete with the growth market cap.
Interesting. We're going to talk actually to a value-focused investor later in the hour who also has some picks for us. So that should be interesting. Stephanie, when your shop looks at the whole stock versus bond debate, right? Everybody loves fixed income going into 2023. Are you guys in the same camp? And again, does any of that change given what inflation print we got today and what we might continue to get?
No, we continue to like stocks or bonds over stocks. The bond outlook is pretty attractive. You have yields that are pretty elevated. On top of that, you could have capital appreciation. If this recession view plays out, you'll get a decent return in your fixed income. And even if it doesn't, even if we end up in a soft landing, you'll have a nice yield, and you could even get a little bit of capital appreciation with yields falling from current levels. So that's the area of the market that we like the most. And then when it comes to the stock market, we're a little bit more selective. So like Marianne just said, smaller cap is interesting today. Their valuation is at a more attractive level. And that's the area of the market that we would be putting money to. So it's certainly core fixed income. That's the most attractive part of the market for us today, especially given our outlook for challenging road ahead, especially on the earnings front. And then small and mid caps.
I love you were almost literally pounding the table on that train, to use a well-worn phrase. Saz?
Stephanie, I'll follow up on that too as well. Within your outlook for stocks and fixed income, when do you see the Fed cutting rates, or do you see any rate cuts this year?
We expect rate cuts in the fourth quarter of this year. We expect recession to hit in around the third quarter. So we expect about a quarter lag for the Fed to be convinced that inflation has come back down. And then we expect cuts in the fourth quarter.
Marianne, you said in your notes as well that 60-40 looks good again, which kind of fits in with what Stephanie's saying about fixed income coming back and being a part of the portfolio, right?
Absolutely. So 60-40, 60% stocks, 40% bonds is a traditional asset allocation that is used. And we've said 60-40 is back. And it was never going to be an easy path going from the zero bound to getting interest rates again. But we've been through the pain. The bear market was last year in bonds and stocks, which is very, very rare. And we think this year, yes, bonds are going to do very well, probably even better than stocks. We would agree with that. But we think eventually stocks will bottom out and rally this year. I think you're going to have a bull both in the bond market and the equity market. But what people are also not talking about is you can also now put cash in a portfolio. So you can really use stocks, bonds, cash, because even cash is yielding higher than some of the bonds.
Yeah.
So asset allocation is back.
All right. On that note, a hopeful note here to end it. Thank you so much, ladies. Appreciate it. Sanctuary Wealth Chief Investment Strategist Marianne Bartels and JP Morgan Senior Economist Stephanie Roth. Thanks to you both. Really appreciate it. Well, coming up next, activist investor Nelson Peltz is attempting to join Disney's board, but not if Disney has anything to say about it. We'll talk about that next. Drama at Disney. The company named Nike's executive chairman Mark Parker as its next chairman, while opposing activist investor Nelson Peltz's attempt to join its board. Yahoo Finance's Alexandra Canal joins us now for the latest. Nelson Peltz, really a heavy hitter, right? And it's interesting that Disney says, no, thank you.
Yeah, I thought it was really interesting in this release where they're saying, look, Mark Parker is going to be our next chairman of the board. He's also the executive chairman at Nike. But in that same release, they also directly addressed this proxy fight with Nelson Peltz. And just to back this up a little bit, Peltz's Trian Fund purchased an $800 million stake in Disney in November. Peltz also has an activist campaign with Unilever. He is chairman at Wendy's, but he now wants a seat at Disney's table and will appeal directly to Disney shareholders to win their support for a spot on the company's board. But as you mentioned, Disney made its position incredibly clear. In that release, it said, quote, while senior leadership of the Walt Disney Company and its board of directors have engaged with Mr. Peltz numerous times over the last few months, the board does not endorse the Trian Group nominee and recommends that shareholders not support its nominee and instead vote for all the company's nominees. So really not holding back there. And Trian did say it's not looking to push out Bob Iger, even though they did not really approve of his surprise return in November. Rather, they really want cost cuts, they want structural changes, and they want to find the next Disney CEO, which of course the company wants as well.
Ali, it's good to see Nelson Peltz hasn't lost his touch for creating a slide deck in a 35-page slide deck called Restore the Magic. He just goes through this whole presentation, almost takes me back to what he did at P&G with an extensive overhaul playbook. But part of this, Ali, as you've been reporting here for us, is he wants a change in the CEO. What, in terms of succession, is he looking for here?
And I think everyone wants to approach this a lot more thoughtful this time around, especially considering everything that happened with Chapek. And Mark Parker, even in the release, said that the process for finding a new Disney CEO, that has already begun, and it does include a newly created committee chaired by Parker, which will update the board on succession plans, including reviews of both internal and external candidates. And what you're seeing on your screen now, it's a short list. Those are some of the names that have been floated out, and they include Dana Walden, head of general entertainment content, Alan Bergman, the chairman of Walt Disney Studios, and Josh D'Amaro, who heads the park division. And then we could possibly even see some former employees return, like Tom Staggs, Kevin Mayer. So this is something that Disney really wants to focus on. Bob Iger is going to be a huge part of that decision. And Disney has really thrown its support behind Bob Iger. In that release, it did note that during Iger's first turn as CEO, the company's total shareholder return totaled 554%, topping the S&P 500's 244% return over that same time period. So they are very confident in Iger, but this ongoing search for the CEO is going to continue. This ongoing proxy fight will continue, and it's all going to come at a head at Disney's annual shareholder meeting in 2023. We don't know the date of that yet. Last year, that was March 9th. So perhaps we'll have some answers in the spring.
It's funny the way that Disney parses the stock performance, right, to make it seem more favorable. I mean, they had their worst year last year ever. For the stock price. And so you wonder, when does confidence on the part of Iger turn to hubris? Like, he's here, everything's going to be fine now. He's going to fix everything, right? And so as a shareholder, you would have to wonder, does it behoove them to ignore the advice of someone like a Peltz?
Yeah, and I think it's just going to be this ongoing conversation. As you mentioned, the stock lost 45% last year, its worst stock performance since 1974. And Iger faces a lot of other questions too. Streaming profitability is definitely number one. The stock is bleeding money on the streaming side of the business. You also have this question about what to do with ESPN. Do you sell it off? We have Hulu. Disney still needs to purchase Comcast's 33% stake. So there's a lot going on at this company that I think shareholders, investors are concerned about. And if you take a look at what's happening in pre-market trading right now, it's up almost 2%. So you have to wonder what their thoughts are about Peltz going forward and what ultimately they will vote on come that shareholder meeting.
And of course, we should note Parker and Iger declined to be interviewed by Yahoo Finance, and Trian's folks didn't feel like getting back to us. Ali Canal, thanks so much. Appreciate it. Straight ahead, we'll have the opening bell on Wall Street on the CPI index Thursday. We'll also take a dive into the latest wild move and shares of meme crowd fave, Bed Bath & Beyond. We'll be right back. All right, welcome back to Yahoo Finance here. Let's get to a few hot tickers moving on the Yahoo Finance platform. A crowd favorite always, Taiwan Semiconductor and Focus companies out with earnings, Julie. And the big headline here is some $4 billion cut in CapEx. But I would also bring up, too, the company's outlook for the first half of the year, not looking for much in terms of sales growth. You can make the argument that is as concerning as this CapEx cut. If Taiwan Semiconductor, the most valuable semi player in the industry, is calling out a weak first half, because of weak demand signals, best believe others are probably right in there with it.
Yeah, indeed. It was alarming when the company talked about that demand is softer than we thought 3 months ago. That's what the CEO, C.C. Wei, said on the conference call. And just to put some numbers around what you were talking about with those first quarter sales going to be at most $17.5 billion. Analysts had been looking for $17.9 billion. And then first half sales are going to fall as well. That decline in the first quarter sales is the first revenue drop that the company has had, if it indeed happens, in 4 years' time and then should rebound to slight growth for the full year. But, this cutting that they're doing, it looks like the market, Saz, is, that the market is saying, okay, that's enough to offset some of this weakness. We'll see if that sentiment continues.
And this goes back to what we talked about yesterday. The reason for the cautious outlook in the first half is weak PC and smartphone sales. And this market, it doesn't suggest that those areas have bottomed in any way. That's where you're seeing challenges here. I'm also reading right now a good note on the folks over at Citi. They're still looking for things to rebound in the second half. But we're not getting any signal that demand will automatically reaccelerate for PCs and smartphones, which probably leaves Taiwan Semiconductor, Qualcomm, Broadcom, you name it, all these other chip players, and of course Micron in not such a good place.
One other thing that might be helping the TSM shares this morning, by the way, is gross margins were actually at a record 62.2%, up from 52.7% a year earlier. So a big expansion in gross margin. The company says that might not continue because of what's going on with rising prices. Also, it's ramping up production. It's got a plant coming in Arizona. It's also talking about building a second plant in Japan to expand its production. So we'll see how those plans sort of match with some of the shorter term cutbacks in spending that it is doing. But interesting to see that gross margin number. I mean, we are seeing, in terms of the ripple effect across chips here, not a huge reaction, but a little bit of a lift. And then I was also watching ASML, which is a chip equipment maker that supplies Taiwan Semi, and that stock had been reacting as well, Saz.
Yeah, and one to watch there as well. We're also watching American Airlines. Before we came to air, Julie, that one coming out with some pretty good guidance. And the major call out for American Airlines really appears to be their operating margin coming in much higher than expected for the quarter, about 10.25% to 10.5% they see in the fourth quarter. Their guidance was 5.5% to 7%. It looks like they had a lot of success raising prices during the fourth quarter.
Yeah, it looks that way. And it's also interesting, given the backdrop, of course, for airlines right now. You had Southwest and all of its issues. You had the Federal Aviation Administration yesterday, of course, calling for no flights to depart for a period of some 90 minutes to 2 hours after its pilot notification system failed. Upon further review, the FAA is now saying it had to do with perhaps a software update, some kind of corrupted file that threw a big wrench into the works, but says it wasn't a cyber attack. So that's the backdrop here. Then we get this relieving news, if you will, from American Airlines. So you see the bump up in the shares on that, which I think is sort of a combination, Saz, of the American Airlines news itself, but also the timing coming as it does following that glitch yesterday, which was it was a federal government issue. It wasn't an airline issue, but nonetheless, still a relief, I think, for airline shareholders.
Also a relief, too, and might be impacting margins. This margin outlook from American as well, Julie, is decline in energy prices. When you beat your margin guidance by almost 500 basis points, of course, there's a price component there. American calling out fourth quarter sales up 16 to 70% on a decline in total available seat miles flown during the quarter. So you also have to think this decline in energy prices, we saw it in today's CPI index as well, is of course benefiting a company like this. And it's not just American Airlines. Of course, off of this release, you are very likely to hear some positive things from a Delta, you name it. Maybe just not Southwest, of course.
Yeah, maybe Southwest is going to be taking it. But it'll be interesting to see what, even Southwest, what it sort of if you exclude the impact of what happened over the holidays, we'll see what Southwest numbers look like. Revenue for each seat flown a mile, which, as you know, is a big measure that people watch for the airlines, was up by 24% over 2019. So that's better than the company had forecast. Non-fuel costs on that same basis, though, were up by 10% at the high end of a prior forecast. So all of these interesting measures when we look at the flight number, at the airline numbers. One more thing, by the way, I do want to mention. Airfares were down. We just got the CPI report. Airfares were down about 3% in December from November. So that's something to watch as well. Cost management going to be, and capacity discipline going to be really interesting and important for these airlines as we start to see the fares come down a little bit here, Saz.
I wanted some excitement in the CPI, Julie. Just not getting it. Not getting it.
Not getting excitement?
Just not getting it.
You're not excited by the fact that eggs are now 11% more expensive than they were the prior month?
I think I've got our trip to the World Economic Forum on my brain, Julie. Look forward to flying out and touching some snow here. Looking forward to it.
Maybe you can do a little price check on eggs at the Swiss supermarket and see how they compare to the eggs here in the United States, Doug.
And then we have the opening bell on Wall Street, Julie, on this CPI Thursday. Again, CPI coming in a little lighter than expected. There we see our former colleague, I think on the right, that is Joe Lambert. It's good to see Penson down there on the New York Stock Exchange on the CPI Thursday. And again, markets, lots to digest here, Julie. Do you focus in on the areas of clear inflation in rent? Or in eggs, like we've been talking about all morning long, or do you focus on the fact that the headline slowed month over month?
Yeah, it looks like people are focusing on the slowing, the good part of this report, at least if you're judging by the opening numbers here. We've got the Dow higher by nearly 100 points, so not a huge gain by any means, and we'll see if it lasts. Right now, just up a 0.25%. The S&P up about the same amount here, 0.25%. The Nasdaq up about 1/3%. As you know, I have been watching these bond yields very closely. To about 3.5% is where we are on the 10-year, even though on the face of it, today's numbers don't change anything in terms of the Fed's trajectory, but we are seeing bond yields come down. This continued disconnect between what the Fed is telling us and what the market is showing us in terms of what they think the Fed is going to do. Let's also take a look at some of the opening movers here when we look at the various heat maps and such that we tend to watch. And we are having, there we go, a little bit of slowness there in our heat map. But we are seeing Amazon helping lead some of the gains. It's up by 2% out of the gate here this morning. So that stands out to me. Tesla shares are down by 0.8%, but really a mixed picture here, which leads me to believe maybe we will not see some of these early gains hold up. We will watch sectors as well. Just quickly here, taking a look at the sectors, a lot of green here with the exception of the XLV, which is down about 0.5%. Energy and consumer discretionary leading the pack. And then one other group that we continue to watch here that has been more active as of late, it is the meme stock. So we are seeing memes largely in the green here this morning. Let's equal weight them so we can get a little bit of a more clear picture. And right here, Brian Sozzi, it's your favorite stock in the upper left, Bed Bath & Beyond, trading higher by 15% on the day. We talked a lot about this stock yesterday, along with Party City, its partner in perhaps going bank, not partner, but both of them are potentially going to be filing for bankruptcy protection.
Carefully, my friend.
Yes, so Bed Bath & Beyond on our mover list again.
Yes, it's just living there. You know, I did a piece, it's on our homepage right now. I encourage everyone to check it out, run through some of the short selling data from our friends at S3 Partners provided to us. But you've seen a massive short squeeze in Bed Bath & Beyond this week because they did not utter that word bankruptcy on their earnings release on Tuesday. That really seems to have set everything in motion. Right now, you're looking at about 140% gain on Bed Bath shares compared to the opening price on Monday. Really, despite the fundamentals of this business continuing to be very, very bleak. You know, as S3 warns, they put out a new note that I got my hands on last night. The stock price could very easily go to zero just based on where the company's outlook looks like.
Yeah, definitely. I mean, I don't know what more to say about it. It's a waiting game at this point.
So true. All right, let's turn our attention to KB Home. Not a good quarter here. I was just actually reading Our very own Danny Romero reporting a little bit more on this earnings report out of KB Home last night. I think some of the big numbers, or the big number that everybody's focused in on, you see the stock down 3.5%, is orders. Orders down 80% in the most recent quarter. It's a stunning decline, of course, driven in large part by the slowdown in housing because of rising interest rates. But another number here, Julie, to think about, orders so far quarter to date, down 72%. I mean, these are just stunning declines, but it really goes to show the state of housing in this country as those rates have climbed.
Yeah, and what's interesting about that 72% decline thus far, Saz, as RBC analyst Mike Dahl points out, things have been getting a little bit better on the rate front, right? We have seen mortgage rates that have come down very slightly from their recent highs, and that did not seem to help matters, or at least not yet, for KB Home in terms of those orders for the quarter to date. I guess unless you think a 72% drop is much better than an 80% drop, but not really, right? So it is interesting, and looking at potentially for eventually some kind of recovery in some of these home builders based on what happens with rates, but it's not in sight at the moment, Saz.
Yeah, and of course, off the home builders, you have to watch mortgage plays like a Rocket, you name it. All these companies are in the same boat. But I love, Julie, just listening in on that KB Home earnings call last night. They refused to utter the word 80%. No executive wants to go on an earnings call and say, hey, our orders are down 80%. They just gave the numbers, made me giggle. Obviously, it's just a play on words.
Yes, we all read the 80%, so we know what happened.
We can all use the calculators, guys. KB Home, we can do math. Yes. We can do math.
All right, coming up next, Yahoo Finance's Inez Frey is going to break down the latest market action. Bitcoin hitting its highest level in a month. Would you look at that? We'll be right back. Welcome back to Yahoo Finance Live. We are taking a look at markets here that are gaining a little bit of ground. Actually, I take that back. Not anymore. As I mentioned earlier, when I was looking at the Nasdaq 100, we were seeing a mixed picture. I said, maybe we're not going to hang on to these gains. Indeed, we haven't. Ines Ferreira at the Wi-Fi Interactive. What happened?
We haven't hung on to the gains. In fact, in pre-market, after that CPI print came out, we had seen futures lower. Then they went positive, and that's after Philadelphia Fed President Patrick Harker had said that a 25 basis point for the next rate hike would be appropriate. So that had sent futures positive. Markets opened higher, but they did not stick to those gains. We're looking at right now the Nasdaq Composite down 0.3%, the S&P 500 down about 0.1%, and the Dow down 26 points, down slightly. Looking at the sectors, we have been watching energy, communication services, technology seeing some gains over on the Nasdaq 100. Quite a bit of red that we're seeing here. Tesla down 2%. You've got Meta and Microsoft that's hanging on to some gains. I want to point out what's been happening with crypto because we have been seeing Bitcoin up 9 straight sessions. Now remember that Bitcoin trades 24/7. So we did see when that CPI print came out, we saw Bitcoin go lower as assets were all going lower. And then we did see a spike up again. We are seeing Bitcoin right now just above 18,111. Ethereum also has done well over the last 10 sessions or so. We have been seeing Ethereum up 4%. And that has done well for today, the crypto-related stocks. We are seeing some gains with crypto-related stocks. Do want to point out that Sam Bankman-Fried, the founder of FTX, who is under house arrest, is now on Substack and is talking about on Substack, giving his account of what has happened with FTX International. Much of what he also has said in the past in previous interviews, but now he is doing this unwritten word in Substack, and one of the lines that he said is, "I didn't steal funds and I certainly didn't stash billions away." Interesting that he has his lawyers, I'm not sure what his lawyers are saying about him saying all these things and what he's been saying in interviews in the past and now on Substack. Brian?
And is that a free newsletter or I have to pay for that?
I couldn't hear you for some reason, Brian, because my IFB's off, but...
All good. All right, Ines Ferreira, thanks so much. Appreciate it. All right, now would be a good time to pick up a used car. Used car price tracker Manheim is out with its final pricing data for last year, noting that prices plunged 14.9% on the year. That was the largest year-over-year decline on record. And within today's CPI release, I should note, used car prices dropped 2.5% in December, the 6th straight decline. All right, ahead of big bank earnings on Friday, we'll talk with one investor making a bullish call on Bank of America. Don't go anywhere. Teeing up some winners in banking on their success. Many traders are turning to perceived value as they hope to weather the year. With lowered valuations, that might make picks from big banks to small caps more tempting than others. Here with more is Jonathan Boyer, president of Boyer Research and host of The World According to Boyer. Jonathan, good to see you. As always here, make the thesis, walk us through your thesis on value stocks and why is now a good time.
Well, first, thank you for having me. Yeah, no, I think it's always a good time to invest in stocks that are selling below within their worth, but now is a particularly good time, especially with the implosion in some of the mega cap tech names. We're finding a lot of value, especially in the small cap space. We just came out with our annual Forgotten 40 report, which is our 40 best ideas for the year ahead. And about 40% of the Forgotten 40 are in small cap names. I think it's the cheapest area of the market.
So when you look at the Forgotten 40, what are some of the main criteria that you look at to figure out what to put in there?
Yeah, they're not our cheapest names. There are names that have shorter term catalysts. We're normally very long-term patient investors, but we're looking for what will do the best in the year ahead. And that's what Forgotten 40 focuses on. And we think in 2023, small caps are the place to be, as well as banks and some other names.
So what are the catalysts? You said that they'll have catalysts this year. Is it sort of company-specific catalysts in each of those instances, or are there some big macro catalysts that you're looking at?
Yeah, definitely company-specific in the most cases, whether they can spin out a division, whether they can be taken over. It's definitely a name-by-name thesis.
Jonathan, if we're nearing a recession, why do you like banks and notably Bank of America?
Yeah, well, Bank of America is a very different bank than it was in the last recession in 2008. Brian Moynihan, Jamie Dimon gets all the credit, but I think Brian Moynihan is one of the best bank CEOs out there. It has great credit quality. It's extremely sensitive to a rise in interest rates, as you see in their net interest income. And I think, last year this was a $50 stock. A recession, I think, has been more than reflected in the decline in the price.
That one is definitely not a small cap, though, obviously.
Yes.
Is this the only bank that that's in the Forgotten 40 at this point?
We have another smaller cap bank, Citizens, in there as well. But I think if I was to choose one major bank, it would be Bank of America. It's just extremely well run. It's going to benefit from a rise in interest rates, as I mentioned earlier. It's also done a terrific job in expense reduction. So there's a lot of good catalysts coming for it.
Jonathan, do you view tech stocks as forgotten stocks at this moment?
I think that's a case-by-case basis. There are a lot of tech stocks that are down 70, 80% from their highs that are never coming back. And there are other stocks that are down significantly that will that will improve it. This is definitely a stock picking type of environment, and what worked well over the past 10 years is probably not going to work well over the next in the medium to long term.
One of the other stocks you like, by the way, I believe is Topgolf, right?
Yes.
Callaway Topgolf. What's the catalyst in that particular case? Because we've already seen for many of these sort of so-called reopening plays, right? There's already been some enthusiasm. What does 2023 hold?
Yeah, Topgolf is an extremely interesting story. This is the company formerly known as Callaway.
I have to say, I was thrown off when I saw MODG because I didn't realize that was the new ticker.
Yeah, they changed it. It used to be Eli,
right,
to reflect the founder, and now they've embraced a modern golf concept. And this is essentially an entertainment company. By 2023, I think about 50% of EBITDA will be from Topgolf, so it should garner a higher multiple. The Topgolf business is on fire. The CEO, Chip Brewer, who has done a fantastic job, is buying shares, as is the CFO. So there's a lot to like there. And this is a stock that was in the high 30s and now is in the low 20s. And we think is selling a significant discount to private market value.
Saz is a big Topgolf guy.
Good. I hope you go more.
I am, Jonathan. I really do enjoy going there, and because I do go, I can tell you it is quite expensive. And if the economy is slowing down, people are getting fired. I mean, you have to think a $200 night out at Topgolf is the first thing to get cut, no?
That certainly is possible. I mean, if we go into a deep recession, this is a stock that won't do as well. But if you think you'll have a mild to moderate recession, I think the bad news is more than priced in.
Jonathan, good to see you. Thanks for coming in. Jonathan Boyer of Boyer Research and host of The World According to Boyer. Thanks so much. Appreciate it. Coming up, Subway is reportedly mulling a possible sale. Saz has got his take next. Subway, as in the sandwich chain, might be up for sale. Its valuation could hit more than $10 billion. That's according to the Wall Street Journal. If a deal was reached, it would be one of the biggest in the fast food industry since Inspire Brands bought Dunkin' for $11.3 billion in October 2020. Saz for sure has got a take on this one. I'm excited to hear it, Saz.
Oh, Julie, those photos, it doesn't look like my Subway. Where did we get those photos from? I've never seen a meatball at Subway look like that. It looks like things my granny used to make. But nonetheless, here are some reasons why I think Subway would not be an acquisition by any company. Private equity, another restaurant chain, you name it, whatever it is. Here's 7 of them. First up, the great hamburger reinvention. I really like what McDonald's, Burger King, and Wendy's have been doing to reinvent their menus. They've done good things, and I think have stolen share from Subway. Number 2, the drive-thru remains ever popular. It really rose or regained, I think, its claim to fame during the pandemic. It continues to be very popular. You have companies like a Shake Shack now aggressively, and even Chipotle, rolling out drive-thrus for a good reason. Number 3, Subway not seen as a mobile ordering beast. I won't spend too much time on that, but the big winners there, of course, is Big Pizza. And does the food really travel well? And maybe I'm wrong here. If you're watching this, tweet at me. Maybe I just don't have it right. I just don't think Subway sandwiches travel too well. I have ordered things from this company. They have arrived to my house with soggy bread. Not a fan of that. Number 5, too many locations to operate really well, Julie. 37,000 locations for Subway. By comparison, Firehouse Subs, now owned by Restaurant Brands and our friend Jose Sill over there, about 1,300 locations and seen as a better executor than the folks over at Subway. Number 6, margins under siege during periods of high inflation, bread, eggs, you name it, all that stuff on a Subway sandwich under pressure, hurting margins. And then last but not least here, something I think very important, tarnished food quality image, whether it's the issue with an ingredient from yoga mats being used in their bread, or more recently the tuna. This company has battled a lot of just things a normal fast food company hasn't had to battle. And to then, a couple months ago, we caught up with Trevor Haynes, president of North America. I asked him about the state of the tuna business. Here's what he said, because I think it really explains everything I'm trying to explain here to you guys.
Look, so our tuna is nothing but 100% fantastic tuna. It's delicious. If I can get you a tuna sub, I would bring you one there today. If you want to learn more about it, subwaytunafacts.com. You'll find plenty of info.
You look
skeptical. You look skeptical, Saz.
Julie, I'm still skeptical. Just the fact I had to ask a fast food executive if their tuna was real just is not a good thing. Now, he says it's fantastic tuna. Maybe it is, but I shouldn't even have to ask a fast food company, is your tuna tuna? It's just absurd, but I think highlights everything wrong with a Subway. And it potentially, if you buy this company at $10 billion, like the Journal is reporting, well, what is it worth a decade from now, given all the trends that I've outlined? Is it worth $5 billion? Is it worth $2 billion? Whatever it is, I'm not the one crunching the numbers on here. I'm just highlighting some things that might destroy value over the company over the next decade. To that end, here's my take on the Subway issue here this morning. And that is, I wish Subway well. I grew up eating Subway. I appreciate the $5 footlongs. I ate a lot of those in college. But have you tried Jimmy John's or Firehouse subs, Julie? Wow, much better quality there. Much better quality.
I am not a fast food person as a general rule, nor am I much of a sub person, admittedly. But if I was going to have a sub, it would not be from a Subway. Brian Sozzi.
Well, the tuna's real, Julie, if you go there, just so you know. Tuna's real.
It's real and it's spectacular. We'll see.
Fantastic.
Coming up, it's a big week for big banks as earnings kick off tomorrow. We're going to break down what to expect with RBC Capital's Gerard Cassidy. That's next.
Welcome back to Yahoo Finance. I'm Brian Sozzi here in my palatial kitchen, and that right there is Julie Hyman in our HQ studios in New York City. Let's get a quick check of the markets here on the CPI Thursday. We're seeing really Losses accelerate to the downside after that CPI release earlier on this morning. Right now, all three major indices in the red. Nasdaq leading the way lower. All right, here are a couple things we're watching here at this moment. The closely watched consumer price index came in line with estimates, dipping 0.1% in December. We'll dissect what this means for the U.S. economy with a member of the White House Council of Economic Advisors, that is Jared Bernstein, later on this hour. And earnings season quickly approaching, kicking off tomorrow with the biggest U.S. banks reporting. We'll look ahead at what might be in store for investors. And also taking a look at Bed Bath & Beyond shares. They have seen a wild ride this morning as bankruptcy still looms. However, one business's misfortune may be another business's gain, as we will talk with Anisha Sherman a little bit later on in the show. But Julie, over to you on this CPI.
Yeah, CPI print coming in bang in line with estimates, still showing a gain of 0.3% month over month on a core basis. Earlier, we saw positive reaction to that number. It's now pretty much gone away. We see the Dow now down by about 56 points. But we are seeing a little bit of bouncing around here this morning as investors try to assess CPI and what it means and what is going to happen next. But all three major averages are now down. The Nasdaq down the most, falling by almost 1%. We were earlier talking about rates and where they were going. They're still lower, not as much as earlier. Now we are only seeing a basis point decline in the 10-year yield, 3.55%. Earlier it was 3.5%. So the come down in stocks has coincided with a bounce off the lows for rates. Something interesting to note here. Also, what's responsible for the decline in stocks now from a sector perspective? I got the answer for you here. Energy is still in the green along with industrials, but healthcare is now leading the way down. It was the only group that was in the red before. Now it is more deeply so. Consumer discretionary and information technology also taking a hit in today's session. And then I mentioned the Nasdaq as the worst performer. We like to look at that Nasdaq 100 heat map, which was just about divided from gains and losses before. Now it's all down, and Tesla down amongst the most here. You can see it's in dark red here, off by 3.5%, resuming some of its recent declines. There is a report that the company has now put a pause on some of its expansion plans at its plant in Shanghai, something to continue to watch. We're also going to be watching what's going on with bank stocks tomorrow. Let me call those up real quick. Those are still in the green, but a lot of big banks are going to be reporting their numbers. The impact of rising rates and elevated inflation going to be in particular focus as we watch the banks here tomorrow. So let's get a preview on what to expect when it comes to the bank. Well, let's bring in Gerard Cassidy of RBC. Gerard, it is great to see you here. So give us sort of a big picture look, first of all, as to what we should expect from the banks. It feels like generally for earnings, expectations are pretty low, although I don't know if that's true for the banks in particular.
Well, Julie, I think what you're going to see with the banks reporting their numbers tomorrow are very good numbers. As you pointed out, rising interest rates have been so positive for the net interest margins for the banking industry. We've been covering the industry for a very long time. And I have to tell you, I don't ever recall seeing banks report net interest revenue growth year over year, anywhere between 20 and 30%, which is what we're going to see tomorrow. So it's been a very strong top line revenue growth for the companies. Now, the real question is, as the economy slows in 2023, what will the credit losses do? And of course, they're likely to go higher. The question is how much higher, and how much money do the banks have to put aside tomorrow for these expected credit losses? But we think this revenue growth is going to more than compensate for the higher credit losses. So we expect to hear that tomorrow the revenue is good. Loan growth was strong in the fourth quarter. Credit's going to be strong. And I think the real question is, what will these management teams say about the outlook for 2023?
Gerard, I want to hone in on JP Morgan. I think it's been out on an island somewhat over the past few months. And by that I mean we see Goldman laying people off. We see BlackRock laying people off, just given the slowdown in M&A and other investment, other parts of the business. Is it time for JP Morgan to be more aggressive on cost cuts, then also pull back on some of this tech spending they've been very aggressive on in the past few quarters?
Brian, it's a really good question, because of all the stocks, JP Morgan has been the stock that has been questioned about their expense growth. It's been higher than its peers. And I would say that on the tech side, there really will not be any cutbacks for JP Morgan or any of the other banks because tech spending is so critical. Now, there may be an ability to maybe resize the workforce. Obviously, you pointed out about Goldman Sachs. They had a sizable downsizing of their workforce this week. But Morgan's been hesitant to do that. They see more opportunities in the investment banking area, even though we all know that was a very difficult period in 2022 for JP Morgan and its peers in investment banking. So I think what we'll see is that they'll look to slow the growth expense down, but I'd be surprised if there's any big significant cuts coming out of JP Morgan coming from either tech spending or downsizing their workforce.
I do wonder if they're going to pull back on small acquisitions, Gerard. And admittedly, I know this is a minor story, but it is such a fascinating one coming out in the past 24 hours. First, the Wall Street Journal saying that JP Morgan is alleging that a company it purchased is accusing it of fraud, effectively. A college financial aid platform called Frank. It bought it for $175 million. Now CNBC is saying that it's shutting it down because it said the founder made up 4 million accounts. I mean, I'm just curious what you make of that story and the company's oversight and diligence in making this kind of acquisition.
It's interesting because, when you buy these digital companies or these online companies, it's quite a bit different than buying a traditional bank. And obviously, JP Morgan, as well as its peers, they've built their franchises with the consolidation of traditional brick and mortar banks. So there's a higher degree or greater degree of risk in this internet space, if you will, when it comes to financial services companies. Obviously, this is a terrible situation for them, even though, as you point out, relative to the size, it's a manageable number they can handle. But it does have to question, they have to go back and relook at what went wrong with the due diligence and how to fix it so this doesn't, happen again in the future. But they are, under Diamond's leadership, he's been incredible for shareholders since he's been at JP Morgan. They are looking to become, very tech savvy, and they do it both through organic growth as well as acquisitions. And unfortunately, this was a step in the wrong direction.
Gerard, who has not necessarily been keeping pace with some of the others in the industry, and that's Goldman Sachs. I mentioned the layoffs here, but that stock now really trading at a pretty noticeable relative discount to the likes of their competitors. How much pressure, when you talk to investors, how much pressure is David Solomon underwrite here to start executing better, and what else should they be doing?
It's interesting with Goldman Sachs. It's a premier, we all know it's a premier investment bank. But the investment banking business is cyclical. And as much as how difficult it is today for them and their peers, we have to remember 2020 and 2021 were absolutely gangbuster years for Goldman Sachs and the industry. And now we're in, obviously, the downswing in investment banking was far more severe than any of us expected, but it's eventually going to come back. The world needs to access the capital markets. We're just in a downswing. And unfortunately for Goldman, they are, that's their primary business. Now, where there's been a misstep, of course, under Solomon's leadership, has been the expansion into consumer banking. And that, I think, is where the criticism is appropriate because they haven't executed there. But in terms of the actual investment banking, wealth management, trading, or markets, Goldman's doing a very good job. It's unfortunate, though, the market conditions really are what's driving, in my opinion, the lower valuation. But if we look at Goldman, Brian, over many years, 5, 10, 20 years, and you look at the value they've created for their shareholders, it's been very positive. They're in the top quartile of the top 20 banks, even though on a valuation basis today, they do trade at a discount to their peers.
Gerard, put it all together for us, if you would, and just briefly, what's your favorite bank stock going into this earnings season, and what's the one you're avoiding?
Well, Julie, I would say that when you look at the banks in the big picture, it's really interesting today because, as you pointed out in the opening remarks about higher interest rates, that the right side of the balance sheet for the commercial banks is critical. Now, for 15 years, we didn't have to worry about that because if the Fed kept Fed funds rates at 0 to 25 basis points, the value of those cheap consumer core deposits was very low. But if the Fed is going to 5 or 5.5% on Fed funds, and you as a bank have a bucket load of cheap core consumer deposits, you're going to have a real advantage. And I think that's going to show up again in this quarter. So the regional banks, names like Fifth Third, KeyCorp, PNC, M&T, I think are the names to play. Those are the ones to watch because they have those cheap core deposits. And then I think on the investment banking side, we got to be very careful. So to avoid the names like Goldman that we just talked about or Morgan Stanley.
Gerard Cassidy, RBC Capital Markets Head of U.S. Equity, Bank Equity Strategy, and Large Cap Bank Analyst. Always good to see you. Enjoy the start of earnings season tomorrow. We'll talk to you soon. All right, the FTX saga continues as Sam Bankman-Fried releases a blog post detailing his defense regarding the collapse of FTX. Bankman-Fried claims not to have stolen funds nor stashing billions away. This comes after pleading not guilty earlier this month to federal fraud charges. Here with the latest is Yahoo Finance crypto reporter David Hollerith. David.
Yeah, as of this morning, Bankman-Fried has a Substack, and the post, this first post that he's put out, it's the most detailed account we've had from the former crypto billionaire turned, facing federal charges now for fraud about his exchange's collapse in November. And the details of the post draw on Bankman-Fried's memory of FTX and Alameda's financials before he was booted from the company and access to that information was revoked. So it's based on memory. He's claimed that FTX US, the exchange or the US subsidiary of the larger exchange, is fully solvent, and also argued that FTX experienced collateral damage from a liquidity crunch that was sort of similar to what happened to some of the other crypto lenders that went belly up earlier this year. Now, importantly, there's nothing in FTX's terms of service or terms of use that make mention of it being able to lend customer assets or act as a lender. Bankman-Fried also accused the law firm Sullivan and Cromwell of pressuring FTX into bankruptcy, and said that given more time, the company could have come up with the funds to have staved off bankruptcy. So this is pretty much just a more detailed account of what we've already heard him say. And importantly, he doesn't go into the accounting issues that he previously had named as the problem for how FTX became insolvent, nor does he address the Alameda backdoor, which, as we know, Bankman-Fried directed his CTO, Gary Wang, to create, which essentially granted his trading firm Alameda Research a credit line of up to $65 billion against the exchange's asset balance. And that, of course, allowed Alameda to use customer funds. All this to say, we're going to probably see more of Bankman-Fried writing, and this is all probably going to play into his legal defense. The 30-year-old is out on bail, awaiting an October trial related to 8 counts of fraud. And right now he's living in his parents' home in Palo Alto. So, maybe this is the best thing to do in his mind.
I guess so. But what's a funny footnote here, Dave, is that reportedly initially on this Substack post, he posted something asking for people to chip in to like the digital tip jar, right? I don't know if that's just like automatic when you put something on Substack, it's just there. And then he took it off. I don't know. I didn't actually see that. I don't know if you did.
Yeah, it appears to have been just bad timing. I think automatically Substack does that, but clearly it does look conspicuous when he's, asking for people to pay to support him. But we don't know his financial state at this point, so maybe he does need the money.
David Hollerith, thanks so much. Appreciate it. All right, before we head to break, we're locked in on a bullish pre-earnings call on Uber from BTIG analyst Jake Fuller. Says Fuller, Uber stock has rallied off a late December low, but remains below the mid-November mark. And we continue to see Uber as attractive, with ramping profitability, building visibility around its 2024 operating profit target of $5 billion. Fuller's $43 price target on Uber assumes 54% upside from current levels. Coming up, a loss for Amazon on the union front. Julie has the details and other top headlines next.
Here's a check on some other headlines we are watching. Walmart is looking to sell more of its tech to other companies. The big box retailer is teaming up with software giant Salesforce to boost the use of its Go Local and Store Assist offerings. Both will become available through Salesforce's App Store. The move, part of Walmart's wider strategy to diversify away from retail. Go Local was launched in 2021 in a bid by the company to build alternative revenue streams. The nation's biggest grocer has been one of many retailers battling higher inflation. It gave a cautious outlook in December after slashing profit forecasts over the summer. A batch of classified documents have been found at a second location belonging to President Biden. This is according to various media reports after an initial report by NBC News. The White House was already contending with revelations that classified files were discovered last November at a think tank office that Biden used after he served as vice president. It appears the classification level of the new set of files is still unclear. Last year, of course, the FBI seized boxes of classified documents from the Mar-a-Lago residence of Donald Trump. That's after the former president refused to turn them over. The Biden documents were submitted voluntarily. And Amazon's labor union's groundbreaking victory in Staten Island last year should be recognized. This is according to a ruling from the National Labor Relations Board. Last spring, the union won the right to represent around 8,000 workers at the JFK warehouse in New York. The NLRB ruling was in response to Amazon contesting the vote. Amazon claiming it was improperly influenced by union organizers. Amazon's expected to appeal this new ruling. The worker effort, of course, was spearheaded by former Amazon employee Chris Smalls. He's since become something of a spokesman for the labor movement. Saz?
Apple is reportedly seriously considering adding touchscreens to its Mac lineup. A move like this marks a reversal of the company's long-held stance that computers shouldn't have touchscreen capabilities. Founder Steve Jobs famously saying it's an ergonomically terrible idea. Yahoo Finance tech editor Dan Halley is here with all the details. Dan, you review a lot of these tech gadgets. Is a touchscreen in a Mac really something that people want?
It depends, right? You know, this is something that if it happens, it would come, according to Mark Gurman, 2025 in the MacBook Pro. The thing is, you know, the MacBook, the way it's designed isn't really great for a touch screen when the screen's up and down, right? If it's bent back a little bit, that can work. I've used touchscreens, as you said, on Windows laptops, you know, constantly. Believe it or not, it makes it a better experience. You know, when they first came out, they weren't great. Now they're amazing. I like to use it to scroll on the web, go through websites, select stuff. I mean, you know, when I go from reviewing a Windows laptop back to my work Mac, I start trying to poke the screen. I'm like, oh wait, that's right, this doesn't work. And it's, you know, I'd rather have that touchscreen option. So it depends on how Apple goes and like kind of zhuzhes the design of the Pro, just because you're going to need to have it fold flat. Chances are they're going to try to add an element where you can use perhaps the Apple Pencil, and so you can do maybe some light editing, things along those lines. But you know, the big deal here is, will it eat into the iPad segment? Look, the iPad is, in my mind, at least to me, it's a consumption device. It's, you know, my wife and I bought one. It literally doesn't leave our exercise bike. It's there to stream YouTube TV or Netflix or whatever that she happens to be watching while she's exercising, or I happen to be watching while I'm exercising. And so it's, you know, it's not something that we use on the reg, but a laptop we do. So, you know, I think it just makes more sense to kind of go in this direction for Apple and keep the iPad. Obviously, it still continues to sell, but, you know, when it comes to the average person, I think a laptop is just generally better overall than a tablet. And, you know, Microsoft made that move to put out the Surface laptop tablet combination. It works, man. It's actually very, very good. So I think if people kind of saw that and used that, they would recognize that Apple probably should have been doing this for a while now.
Yeah, I wonder if that's also linked up to the reports about screens, and will Apple be sourcing different screen designs? Who knows? My kids use the PC touchscreens. Yeah. And the only you get a lot of fingerprints all over. You got to clean that screen off.
You got to clean it.
Let's talk about gaming as well, which I know is a big favorite topic of yours. Amazon and Google are struggling to get their gaming efforts off the ground. What's going on there?
Yeah, Amazon's John Smedley is leaving. He was one of the executives behind Amazon's gaming effort. He had been there for quite some time, since it basically kicked off. Amazon's gaming effort They have what's called Luna. That's their cloud gaming offering. They also have a gaming studio. The studio hasn't really done quite well as far as releasing games. The cloud effort, we don't really know how that's doing. They don't break out the numbers for us, but it doesn't appear to be, anywhere near what Sony, Microsoft, Nintendo are doing. Nvidia on its own. There's Valve's Steam. It's not in that category at all. And I think, Google, they tried to launch their own gaming platform called Stadia. They're shutting that down on the 18th. They tried to make a game studio. The cloud effort's closing. They closed the studio. They might move the technology over. So it just shows that, these, despite the fact that these are massive companies with just an arsenal of, money behind them, they don't really necessarily have the I guess what it takes when it comes to gaming. Look at Microsoft. It took them forever to become what they are today, which is one of the premier gaming companies in the world. And their cloud service is just beyond better than anyone else has to offer. So it's taken quite a while, and it's a shame to see them calling it quits so soon from these two companies. But maybe it's just because they realize, look, there's three huge marquee names, and then there's the other studios that don't necessarily put out their hardware or their cloud offerings, but we just don't have what it takes to compete in this space.
Interesting.
Dan Alley, appreciate your top analysis as always. And we'll be right back.
Bed Bath & Beyond shares are up about 14% right now. They've been bouncing around quite a bit today after a tumultuous week. Our next guest says with bankruptcy imminent, the retailers that stand to gain the most from available market share and store locations will be the off-price segment. Joining us now is Bernstein analyst Anisha Sherman. Anisha, good to see you. So you did a pretty deep dive analysis here of where there are Bed Bath & Beyonds, where they sort of overlap with off-price. Talk to us about that analysis and what you found.
Yeah, so look, there are a lot of competitors that can stand to gain from a Bed Bath & Beyond stores shut down or ultimate dissolution. That includes Target, that includes some of the online retailers, Amazon, Wayfair, IKEA, as well as the off-pricers. But what we did is we looked at Bed Bath & Beyond a little bit more in detail, and we looked at each of the 880 or so stores in the US, and we looked at who's near them. And shockingly, we found, I was really surprised to see that 99% of those stores, every store except a handful, like 7, have an off-pricer within 5-mile radius. And for individual off-pricers, that overlap is 70%. So 70% of Bed Bath & Beyonds are within 5 miles of a Ross, 70% are within 5 miles of a Marshall's, same with a TJ Maxx, same with a Burlington. The numbers are 70 and up. So there's a lot of crossover in terms of the catchment area of these stores, and Bed Bath & Beyond is an 80% offline concept. So I believe that most of market share will move offline. People don't quickly switch shopping habits just because one store isn't available. They'll tend to go on their usual shopping route and switch stores. And so, within the 5-mile radius, off-price is most likely to win. They have similar stores. They have about 25 to 30 square foot, about 25 to 30,000 square foot boxes in similar kind of strip malls and plazas. And they are very, very overlapping all around the country. So I think they will be the single biggest beneficiary of the share shift that will likely happen.
Anisha, before we can get to that point, Bed Bath has to go out of business. And part of that process, should it happen, is aggressive going out of business sales. How does that impact the apparel industry more broadly and the home furnishing sector as well?
Yeah, that's a great point. So yes, so that's usually the first step is, when they do declare bankruptcy, which they haven't done yet, and when they decide their stores are going to close or a certain amount of stores are going to close, they do a big liquidation sale to try to get as much merchandise out to customers directly as possible. So there will be a GOB sale. It will absolutely impact the homewares sector. Now, I think for off-price, that's less of an issue because homewares is already underperforming. They had a phenomenal year in 2021 when everybody moved or bought a home and was redecorating. But then this past year, as we've been going out and doing more experiences and going to weddings and trips and back to work, we're spending less on the home. So the homeware sector for off-price has underperformed this year. So it's a smaller part of the total business than it usually is. So I think the impact will be smaller because it's affecting a smaller slice of the pie. But for the other impact to off price is how much of that inventory clears. This is a super promotional environment right now. Everything is on deal. Customers are looking for those deals. We're hearing that from the companies. And so a lot of inventory might not sell to customers at full price. So a good chunk of it might have to be cleared through liquidators and jobbers in the secondary market. And that's where off-pricers win as well, because they can buy up a lot of this inventory and resell it later through their own channels.
And what kind of flexibility, Anisha, do the off-price retailers have to hold on to that inventory, right? I mean, I guess in theory, things like towels aren't subject to the same fashion vagaries, right, as a sweater. And so is there a practice that because there is already a decent amount of inventory out there that is not necessarily selling, that they're just going to hold on to it for a while?
That's exactly right. So they have entire warehouses called packaway. At Ross, they call it the hotel because it's short stay, right? And it's entire warehouses just for the purpose of storing extra stuff. I mean, think about it as the analogy of, I go to Costco and I buy a gigantic pack of whatever paper towels and I hold it for the next 6 to 9 months. That is what they're doing at scale. So they're buying whenever they find opportunistic buying, they're storing it in these packaway warehouses. And then when the time is right, they sell it. And so this is an unusual business model. Most retailers don't have a warehouse that is just dedicated to storing extra stuff that they can find on deal for when it's the right time to purchase, to buy it, to sell it. But that's exactly what off-pricers do. And as you said, it's less fashion risk. There's less obsolescence risk because a towel or a rug or a piece of cookware, dinner plates, those are non-seasonal. Those are non-fashion trend driven. And so those will likely sell at full price a year from now.
Anisha, we've seen some really wild trading activity in Bed Bath & Beyond shares, and that continues this week. Really, I think on this view that maybe they turn themselves around or something like that happens and they don't go bankrupt. But based on your experience, once a retailer can't get products on the shelves, once they get into this black vortex of where Bed Bath is now, is there any turnaround possible for this company?
Yeah, I mean, it's always possible. But what we've seen in the recent examples of retailers that have followed a similar path, we think about Pier 1 Imports, think about Sports Authority. If you go back further, Linens and Things that went under in 2008, Forever 21 on the apparel side. I mean, it's hard to turn these businesses around when they're so far down this path. It depends on vendors selling to them on credit. So national brands will need to trust them enough to stock their stores on credit and expect to be paid back. It depends on talent staying in the business. I mean, if you work for Bed Bath & Beyond right now, you need to be willing to stay and hoping that the business turns itself around rather than looking for a new job. So all of these contingencies, and then of course it depends on what kind of debt financing they can secure. So it is possible, but it is the likelihood, each day and each week we go forward, the likelihood goes down.
All right, we'll leave it here. Anisha Sherman, Bernstein analyst. Always good to see you. We will talk to you soon. And we'll be right back.
It's no longer just Brian Sozzi raising the alarms about the grocery bills that people are seeing for eggs in particular. Inflation for food at home ticking higher. The highest jump coming from egg prices, up 11.1% in December compared to the previous month. Brooke DePalma is here with the details. Brooke, I have to admit, when Saz first put this in the Slack this morning, I thought he was reading it wrong. I thought he was looking at the year-over-year number. But no, it is the month-over-month increase in those egg prices.
That's right. You're not alone in the shock. Consumers across the board on social media are flocking, lack of a better word, to social media to really just share what they're hearing and what they're seeing about egg prices. As you just noted, 11.1% month over month, up a whopping 59.9% year over year. That is the largest year-over-year jump since September of 1973. Month over month, the largest jump there since April of 2020. That's according to Steve Reed, an economist at the BLS. And of course, what's the reason behind that? The avian flu outbreak that is impacting farmers across the board. One Wells Fargo analyst told us that the total size of the U.S. egg laying flock was decreased by about 10% when 40 million laying hens caught the disease and had to be, I hate to use this word, but subsequently destroyed in 2022. Of course, the egg production was then impacted. It dropped by about 5%, meaning fewer eggs in the market. And this large drop was the primary reason behind those egg increases that we saw in the month of December.
Hey, Brooke, some of these retailers and restaurants you cover, they might, I don't know, lay an egg when it comes to earnings because of this inflation. What are you hearing from them?
That's right. Well, I heard from a Target spokesperson, and they said essentially that they're selling their private label brand Good and Gather. A 12 count is running about $4.26 at the current time. And they said, quote, while we are experiencing low inventory of some egg products, it ultimately depends on the brand. We are not limiting guest purchases at this time. Walmart had a similar message saying that they also are not limiting the amount of eggs that customers are able to purchase. But get this, back at the end of November, I saw this at a BJ's. It said that they essentially are limiting 2 per a customer there. And so really, when you think about it, there is less inventory on the shelves. Customers are paying more. And one economist said to me, think about it. Eggs are everyday products. You go to McDonald's, you're ordering that Egg McMuffin, you're making eggs in the morning for breakfast. You're not really shying away from them because they cost more. You're still going to pay that higher price.
All right, well, I might have to, I don't know, get a flock from my yard there, Brooke DePalma. Thanks so much for flying in here at the last minute. We appreciate it. All right, coming up on the other side of the break, we'll look at Ryan Reynolds maybe selling his phone brand to one big phone company. We'll be right back. Drama in the Disney kingdom as the company names Nike executive Mark Parker as the media giant's next chairman, while activist investor Nelson Peltz's fights for a board seat despite Disney's rejection. And here to discuss is Geeta Ranganathan, Bloomberg Intelligence senior media analyst. Geeta, good morning to you. I think Nelson brings up a good point in his slide that Disney notoriously is not good with answering shareholders back and really welcoming outside views. How could Disney fix this? Because the stock is at a really, an 8-year low here.
Yeah, thank you so much, Brian. Good morning. Yes, he definitely does raise some very important points, but all of these are already well documented, well telegraphed issues. And I think the Disney board and the Disney management kind of recognizes a lot of the issues that Nelson Peltz has brought up. They are, I think, in the process of fixing most of those issues. And, with respect to your point about talking to investors, we had a very similar situation with Dan Loeb last year, and I think Disney handled that really well. They did sit down with Dan Loeb. They did kind of sit down and discuss all of the different things that he was asking for. He was asking for a spinoff of ESPN, buyout of Hulu. Some of those points are exactly the same that Nelson Peltz is raising, but I think what he's also going to push for is succession, which has been one of the really pain points for Disney.
Geeta, at the same time, do you get the sense at all that Bob Iger is overconfident, sort of dangerously so, in both pushing off Peltz's overtures here and also just generally with the direction that he's taking Disney at this point?
I'm not sure I would call him overconfident. I think he is definitely the best executive right now to lead Disney. They're at a very pivotal moment in terms of their transition from the legacy TV business to the streaming business. He knows what he's doing. He's seen quite a lot of success already with his, streaming plans. Of course, they've run into certain issues, certain troubles, which, is arguably across the landscape. We're seeing this for all of the media companies in terms of their exposure to the legacy TV model. And I very much think that Bob Iger is taking the steps now to kind of fix that, to kind of reinvigorate the content creation process, to reinvigorate the talent, creation as well. It's going to be interesting because I think it's going to come down to execution. I think Bob Iger is laser focused on that. But this, in my mind, this push by Nelson Peltz almost seems like a little bit of an attack on Bob Iger. And I think it's an unnecessary distraction. I think it helps in the sense that it does keep, management honest. It keeps them on their toes, especially when it comes to that issue and succession. But at the same time, if Bob Iger is going to spend most of his time just kind of looking out for his job and keeping it, that's not necessarily good news for the company as a whole.
But Geeta, isn't Bob Iger, I think the street is always so quick to praise him, top executive, of course, but isn't he part of the problem? And secondarily, isn't Mark Parker part of the problem as well? These two folks signed up on a very aggressive acquisition of those Fox assets that, to Nelson's point, may now be worth far less than what they paid for at the top of the market.
I think one could argue that in hindsight, any media deal done in the past is going to look like, you kind of overpaid for it. I mean, that's just the kind of nature of how media multiples have compressed over the past year or so. But yes, you bring up a really, really good point, Brian, in terms of, just kind of looking at how they're going to take this forward, in terms of the strategy. So, yes, I think, Bob Iger obviously has his task cut out for him. We have to see how it goes forward.
Geeta, what do you think is the single most important strategic move that Iger needs to make in the coming year?
So it's all going to come down to the streaming business and about how they are going to reinvigorate profitability in that business. So Disney has already talked about kind of keeping its content budget pretty much curbed in the 30 billion range. But now it's about kind of executing on content creation, on content distribution. We've seen a lot of their content kind of over the past few years really underperform, if you will. One of the prime examples has been animated content. I mean, Disney has been a giant for all these years, whether it came to Pixar, whether it came to Disney animation films. And over the past few months, we've kind of seen seen that really underperforming, whether it was Lightyear or some of their more recent releases, they just haven't taken off. And even if you look at their other movies and, their other franchises, whether it's a Marvel or a Lucasfilm, there is a lot of franchise fatigue kind of setting in. And so they do have to do something a little bit different to make sure that, that process remains reinvigorated. At the same time, they do have to kind of keep their content spending in check.
Do you think Disney has taken seriously and run the numbers extensively on a spinoff of ESPN?
I think they have. This is the issue that keeps coming up every few months for Disney. ESPN, we have to remember, yes, it is a troubled business. It's a challenged business model, but it does, at the end of the day, throw out about $4.5 billion in EBITDA every year. That's about 25-30% of the company's operating profit. So it's absolutely paramount to the rest of the business. It's been kind of instrumental in funding Disney's streaming ambitions. So they have to be very careful. This is a very careful balancing act. It has been all the while for Disney's management team, for Bob Iger. I don't necessarily think that they're looking to spin it right now, but I think what Bob Iger and his team is going to do is really scale down the level of sports rights. We've kind of seen them already do that. They let go of, the NFL Sunday Ticket. They let go of, Big Ten rights. They let go of, IPL cricket rights in India. So they're taking a very, very disciplined approach. And I think that's what they're going to do going forward as well when it comes to upcoming sports rights renewals.
We shall see. Geeta, thank you so much. Good to see you. Geeta Ranganathan, Bloomberg Intelligence Senior Media Analyst. Appreciate it. Well, T-Mobile is reportedly looking to acquire the budget wireless provider Mint Mobile. Why do we care about Mint Mobile? Well, besides the fact that T-Mobile has been making a lot of acquisitions, it's really been leading in the telecom space. Mint Mobile happens to be backed by Ryan Reynolds, the actor. He owns about a quarter of the company, and he's done pretty well before, Saz, by selling a stake in his, or selling, I guess, entirely his liquor company. So, kind of interesting two sides of the story here, the Ryan Reynolds success in business on the one hand, and what T-Mobile is building on the other hand.
Yeah, T-Mobile, look, they continue to gain a lot of market share in this industry. 2 weeks ago, came out with a positive earnings announcement ahead of them ultimately reporting. But it really goes to show a lot of demand for these these prepaid wireless companies. Verizon spent $6 billion to buy TracFone to ultimately compete with an AT&T's Cricket Wireless. So a lot of competition here for an asset, Julie, from Ryan Reynolds that has been very much out front in the media in large part because of his TV ads.
Yeah, he's been the spokesman for Mint Mobile also, so I guess that's why people associate him with the company. But to your point, we've talked to some analysts who talk about that not only has T-Mobile built up that prepaid card business, but also, of course, looks like we're heading into maybe a recession, the very least a slowdown. And so are we going to see T-Mobile gaining even more market share because people are going to be watching their wallets even more closely?
Yeah, and it's still also, I generally assumed, at least on the street, a lot of coverage we read, Julie, that T-Mobile, because it brought those Sprint assets, got a lot of great spectrum, that they have the 5G leadership here in the industry over Verizon and AT&T. And of course, obviously Verizon and AT&T would scoff at that, of course. But look, T-Mobile's market share gains the past year, the sales, the earnings growth suggests that customers are viewing it as probably the best position in 5G.
So that was the T-Mobile side of the story. To talk a little bit more about the Ryan Reynolds side of the story, I'm sort of fascinated by the idea that you have these people in the entertainment industry who have investments in various things that they then sell off. And this, as I mentioned, isn't the first time that Reynolds has done this. He sold some of his liquor company's brands to Diageo back in 2020 for $610 million. And here are some other examples of folks who have done the same. Conor McGregor, the fighter, he and his partners owned another liquor company, Irish whiskey company called Proper Number 12. They sold that, a majority stake in that for a deal worth up to $600 million. Brad Pitt selling a stake in his production company. Kylie Jenner, who owns Kylie Cosmetics, sold that to Coty for $600 million. She sold a little more than half of her stake. Clooney selling Casamigos, which he owned with Randy Gerber, and Jay-Z, of course, Tidal. So interesting here that we've got these folks who are obviously multi-hyphenates.
Julie, I think it makes sense for The Rock to sell his tequila business, which has been on fire, to the folks over at Molson Coors. I mean, why not? They can use a brand like that, and they already work with him with his energy drink. It makes a lot of sense to me. I'm making deals right here. Rock, I know you watch every day. Get at me.
Are you in the market for a tequila business, Saz?
I mean, I don't think I could afford maybe the $2 billion price tag on The Rock's tequila business, but I do enjoy it. It tastes good. I have some in my freezer. It's all good stuff.
All right, excellent. Coming up next, Starbucks is the latest company to announce a return to the office call for corporate workers. We're going to talk about that next. It is time for Cut for Time. 3 stories, 1 minute each. We start with this. Payment startup Stripe has cut its internal valuation again, according to multiple reports. The company is now internally valued at $63 billion, down 11% from its last valuation, and down 40% since its peak. This is the second time since June it has lowered its own view of how much it is worth here as it's done funding. And Saz, this seems par for the course now for this environment that we have seen over the past year when public and private valuations have effectively collapsed for tech startups.
And another Stripe, perhaps one of the buzziest tech startups of the past 2 or 3 years. Our friends at TechCrunch reporting in late November, they laid off 14% of their workforce. So despite that heady valuation cut, it's still valued very aggressively. And another big private tech company cutting workforces, likely to appease various investors who want to see profits faster and who are unlikely able to either get that business sold or bring it to public markets in what was a very challenging year last year.
Yeah, and Starbucks has become the latest company to require corporate employees to return to the office. It starts on January 30th. Those within a commuting distance will return in person for at least 3 days a week. What's interesting to me, I guess, Saz, as we hear more and more companies announcing this, is not just that they're asking people to come back. That doesn't necessarily shock me. It's that they're still doing hybrid. They're not asking everybody to come back every day, right? So this just reflects that things have changed, at least for now, and I'm still wondering whether that is the future of work that is here and it's permanent, or if a year or 2 years from now, people are going to be there 5 days a week.
Yeah, and you have Snap as well add to the list here, Julie. Soon employees will have to be back in that office 80% of the time, which essentially works out to 4 days a week. So there does look to be that hybrid component moving forward, but it also comes at the time, Julie, where look, companies are trying to get as much efficiency out of their business, and maybe that revolves around employees being back in the office, collaborating, and maybe just coming up with ideas that could drive sales in what could be a very challenging year economically. All right, PepsiCo is ditching its 24-year-old Sierra Mist brand and is launching a new lemon lime soda called Starry. I like those cans and bottles there. In a statement, the company explains that demand for lemon lime soda has never been greater as it looks to gain traction against Coca-Cola-owned Sprite. I appreciate the bottling here, Julie. I'm a bit of a packaging freak. I like the name, totally dig that. I'm sure it tastes very well. It just has no caffeine, so I can't get behind this right now until they put that caffeine in it.
So does that mean you didn't like Sierra Mist or Sprite either? Because they don't have caffeine.
And not my first choices. I need a little buzz. I need to get my buzz on, Julie.
Of course you do. Really
well,
I don't think I have ever had a Sierra Mist. Ever?
You're not missing much. You're not missing much. Yeah.
I don't know. I'm not.
Kinda like Tab.
I'm not
It's
a
like
soda.
Tab.
I'm not a soda drinker as a general rule. So I don't know how much opinion I have on a Sierra Mist versus Sprite, or versus Starry for that matter. But I am with you on one thing, and that is the packaging, which strikes me as sort of retro, sort of 80s packaging there. So I'm down with that.
What do you like to drink, Julie? I'm always curious.
Water? Coffee?
Water?
Coffee, water?
I don't know.
Sometimes a seltzer if I'm feeling especially crazy.
Gotcha. Okay.
All right, coming up, Rochelle Akufo is going to continue our coverage of the latest inflation data with CFRA's Sam Stovall. What are you drinking there today?
I've got Highball Energy Seltzer owned by Anheuser-Busch energy drink company. Very good brand. No calories, no sugar.
All right, mixed market. Keep it right here.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast and 8 a.m. on the West. I'm Rochelle Akufo. Here's what we're watching today. A noisy report. December's inflation reading tells U.S. price pressures are cooling, but the individual components suggest a more complicated story is unfolding. We'll hear from the White House's chief economist this hour. And don't look down. With the House changing hands and battles over the debt ceiling looming, we might be approaching a fiscal cliff edge. There could be big implications for major corporations like Boeing and Eli Lilly. We'll explain why coming up. And a leading indicator, one of Apple's major suppliers cuts capex for the year ahead on a weakening chip market. We'll take a closer look at numbers for TSMC and why it all matters for the economic road ahead. But first, let's take a look at how the major indices are faring on that data. A mixed picture, as we see there. They were all in positive territory this morning, but as we can see there, the Dow now up just in the green there by about 0.2%. Meanwhile, the S&P down by about 0.2%. They're about 8 points. And the tech-heavy Nasdaq there down about 0.5%, 49 points. We're seeing of the Nasdaq components, Tesla down about 2.5%, not helping matters. Let's also take a look at what's happening with the Treasury market as well on that CPI data. We see a mixed picture here as well for the shorter term yields. The 5-year down about 1.5%, the 10-year down about 0.5%, and the 30-year just slightly in the green there. Obviously, a lot of time between now and when we hear from the Fed on January 31st for the markets to digest. All right, well, for a closer look at the market action and following today's inflation data, let's get to Yahoo Finance's Ines Ferre. Hey, Ines.
Hi, Rochelle. So we've seen a little bit of volatility when it comes to these markets this morning. Earlier in pre-market, we had seen the pre-market action in the red when it comes to the markets right after that CPI print. Then we saw that flip into green territory. And in fact, we saw the markets open in the green. This is after Philadelphia's Fed President Patrick Harker had said that a 25 basis point would be appropriate. And so that sent stock futures higher. We opened up higher, but then we went into the red again. So we are right now a little bit of a mixed picture when it comes to the markets. The Dow's in the green, the Nasdaq and the S&P 500 are both in red territory. If we take a look at where we're at with the 10-year Treasury note, we are seeing that at 3.53%. And we have been watching the U.S. dollar index, as this so many times indicates what's happening with assets. We had seen that U.S. dollar index, a little bit of volatility here throughout the morning, but it's at 102.69. U.S. crude WTI, that is up more than 1% at 1.4%. Brent crude also today higher, up more than 1.5%. Looking under the hood at equities, we have been seeing energy stocks that have been leading, industrials, communication services, those are in the green. But we're looking at the growth names, technology, consumer discretionary, those are under pressure. Over on the Dow, what's keeping the Dow higher right now is Disney, up more than 3% after announcing a new executive chairman. And also we're watching Boeing, Caterpillar, those are higher as well. But we are seeing healthcare that's under pressure. Johnson & Johnson is down. Over on the Nasdaq, we've been watching some pressure on the Nasdaq with Tesla down more than 3%. Microsoft still hanging on to some gains over there, up 0.6%. I want to mention what's been happening with cryptocurrencies, because we have been watching Bitcoin over the last 9 sessions, gaining 9 sessions in a row, up more than 4%. A little bit of volatility after that CPI report came in, but still it's up above 18,000 per token. Ethereum also over the last month, this past month in January, Ethereum has been up 17%. So some gains that we've been seeing with Bitcoin, with Ethereum, and that also has been having an effect on cryptocurrency related stocks. So today we are seeing some of these crypto stocks that are in the green, Rochelle.
All right, thank you for that market roundup. Ines Ferre there for us. Well, inflation in the U.S. slowed to a 6.5% increase in December, according to the latest read on the Consumer Price Index. Now, that marks the 6th straight monthly deceleration since a mid-2022 peak. Well, joining us now is the White House Council of Economic Advisors member, Jared Bernstein. Thank you so much for joining us this morning. So first, I want to get some of your takeaways, because we know that it was really gasoline prices falling that was one of the biggest contributors here.
Yeah, this is something that's been very important to this president. He consistently talks about the importance of breathing room at the pump for American consumers. Now, in December, according to this morning's CPI, gas prices fell 9.4%. That sounds like a year-over-year number. It's actually a monthly number. We know that gas prices peaked out at a bit over $5 a gallon in June of last year. This morning, I think I saw them at $3.27, so $1.75 off the price of a gallon of gas. That is but one factor in the report, though. We saw used cars continue, I think, a 6 or 7 month negative handle on that part of the index. Airfares down. Core goods continue to reflect the improvement in supply chains. That unsnarling has helped put downward pressure on those prices, too. So it's not just gas, but that's, of course, a prominent component.
And obviously other things that hit home for people, we're talking food inflation, that did tick up as well as shelter, some of these stickier parts of the inflation picture. Why do you think we're still not seeing enough of a decline right now?
Well, last month was actually the smallest increase in food prices in almost 2 years. And in fact, if you go through sector by sector within the components, you'll see a pretty consistent deceleration in the price of foods. Now, eggs, by the way, went the other way, up 11% over the month, and that's very much a symptom of the avian flu. Interestingly, chicken came down, eggs went up. We can argue about which came first, but that's a different discussion. So broadly speaking, though, we are definitely seeing some slowing in food as well. Now, it's not nearly the same as gas, where we've seen actual declines in prices. In food, we're talking more about slower inflation. But I think the key point here is if you look at overall inflation, which of course includes food and gas, it ticked down 0.1% in December, and as we've mentioned, has been decelerating in recent months.
And what do you think this does in terms of recession prospects? Obviously, a lot of people wondering what the Fed is going to do with this information, if the Fed is over-tightening. What does this do for the overall economic picture?
Well, look, from the White House, the way we've talked about this ever since the president wrote about it around a year ago in an op-ed is a transition to steady, stable growth. And the data flow that we're seeing is absolutely consistent with that scenario. That is, it is consistent with an economy that's moving to maintain the achievements we've seen thus far, particularly in the job market. You heard the president talk about that a few minutes ago. An unemployment rate that's at a 50-year low, continued strong job growth, high levels of openings and opportunities for workers. We see the strong job market and this decelerating inflation story as very much consistent with maintaining this transition to more steady, stable growth. At least the current data flow, I think, is quite supportive of that trajectory.
And of course, anytime there's good news, everybody wants to take credit for it. How much do you credit to the president's actions versus what we've seen from the Fed versus perhaps just capital markets doing what they do best?
Well, again, it's a good question because it takes me back to that same piece I was thinking of. So the president sort of outlined a 3-part plan to help maintain the gains we've achieved while putting downward pressure on prices. And those 3 parts were, number one, an independent Federal Reserve. So you're of course right, that's in the mix. Part 2 is doing all we can to help families with the prices that they face in their daily and weekly budget. So of course, his actions on the strategic reserves, releasing oil there, those fingerprints are on the gas results even now. And then deficit reduction has been, I think, complementary to Fed policy in terms of what we call a negative fiscal impulse. That means helping on the inflationary front. So we've more work to do. We are not out of the woods. 6.5% year over year is still too elevated inflation. But we're going to continue to press because I think the data flow, again, is very consistent with A, that the president's plans are working to maintain the gains we've achieved while putting downward pressure on prices, and B, looking forward, we have plans in place to build on these successes, whether it's the chips, whether it, in other words, standing up domestic semiconductor industry, whether it's standing up domestic clean energy production, or reinvesting investing in our nation's infrastructure. All of those work this year, 2023, to maintain the gains we've seen while expanding the economy supply side, which helps with medium and longer term inflation.
And of course, with a Republican-controlled House now, how much of a dampener could that be on some of the economic plans that the president has?
Well, the three things I just listed for you, the Inflation Reduction Act with its investments in clean energy, the bipartisan infrastructure law reversing decades of disinvestment in critical public goods, and the Inflation Reduction Act. Every one of those is in the books. It's legislated. And let me tell you something about President Biden. I worked for him when he was the vice president, when he was the Sheriff Joe, implementer in chief of the Recovery Act. Something that people should know about Joe Biden is more than almost any other holder of high office I've ever worked for, he cares a ton about implementation. And he has told his staff from the cabinet on down, 2023 is about efficiently, effectively implementing these programs on behalf of the American people. Now, from my perspective as an economist, they are pro-productivity, they are pro-growth, they are pro-job, they are pro-environment, sustainable environment. And by, as I said a second ago, by investing in the economy supply side, they're helpful on the longer-term inflation story.
Well, I do want to thank you for joining us this morning. White House Council of Economic Advisors member Jared Bernstein, thank you for taking the time this morning.
My pleasure.
All right, well, let's continue to dig into the latest inflation report with Sam Stovall, CFRA Chief Investment Strategist, along with Zachary Griffiths, CreditSights Senior Strategist. So first, I want to start with you, Zach. I mean, in terms of the biggest contributors here, gasoline. So what does this mean in terms of the whole picture when you have one aspect of it really dominating the picture?
Yeah, when you look at the headline, the big move in energy prices was widely expected, as you saw with the AAA data showing almost a 10% decline in December. So that's important, but perhaps not sustainable. And so I think the move lower in headline CPI is encouraging. I think even more encouraging than the move in energy prices is the drop in food prices, or at least the deceleration in food prices that we've seen for several months now. So this is very encouraging for the US consumer and something that we think is going to continue throughout this year. And so falling input costs generally for companies is a positive for, I think you could say, equities broadly, and we have an overweight investment grade credit call. And so I think these kind of improving input cost pressures can help margins as long as the economy can remain buoyant in 2023 as we expect.
So then, Sam, as we look at the market reaction there, what are your takeaways?
Well, Rochelle, I think there are two takeaways. First off, it's a good example of buy on the rumors, sell on the news. We were expecting there to be a decline to 6.5% on the headline CPI from 7.1, and pretty much we got that. You could also say that the Wall Street was expecting more because we had 2 consecutive months of downside surprises, and today's report merely tracked current market assumptions. So I think it's a combination of investors expecting a little bit more, but at the same time being content with what they got and selling on the news after buying up in anticipation of a favorable report.
And Zachary, we know that the Fed is obviously tracking this when you look at things like core CPI. Does this weaken the case for them to continue their aggressive path? And what does that actually mean as to what that path will look like? Is it definitely going to be 25 basis point hikes from this point?
Well, the market is almost priced for a 25 basis point hike. It had been closer to 30 to 35 basis points over the past couple of weeks. So we think today's report affirms a view that we've held for several months now, that we are downshifting to 25 basis points in February. And when you look at the core goods side, you saw another decline. I think the third consecutive month there was a little bit, it was less of a decline this month than the prior two as apparel costs ticked up a bit. But I think the trend there is in place. We have goods disinflation, and we expect to see shelter costs in particular downshift in the second half of this year. So we think that's something the Fed is aware of and taking into account as it sets policy over the next couple of months. You're seeing part of the economy downshift from an inflation perspective, while there is some clear signs that there's more to come in the pipeline.
And Sam, where do you think the Fed goes from here, especially given that we did have that that stronger than expected jobs data as well?
Well, I think that we're going to get the hike at the January-February meeting, but also possibly another hike of 25 basis points in March. But then we think the Fed hits the pause button. And if history serves correctly this time, we've normally seen the Fed start to cut interest rates fewer than 9 months after their last rate hike. So that would put it in December of 2023, which I think would cause investors to start to look across the valley and feel fairly optimistic that much of the worst is behind us.
And Zach, do you agree? Is that the sort of same timeline that you have for when we might see the Fed pause?
So we think the pause is actually in February. So just one more 25 basis point rate hike, and then pause through the remainder of 2023. So we don't think you're going to get a rate cut this year, but it could be on the table next year, especially if inflation falls the way we expect. We'd have the Fed really cutting back toward a more neutral policy rate from a very restrictive policy rate. And I think the biggest mispricing is the Fed very quickly shifting to rate cuts. The market is priced for a terminal rate of around 4.9% in June, and then immediately cutting after that around 50 basis points by the end of the year. We think that's the biggest mispricing. So we look for a lower terminal rate, but a longer pause at that terminal rate throughout 2023.
And Sam, as people look at their portfolios and wonder what to do next, I mean, JP Morgan predicting that equities will still offer lower returns than bonds, at least for now, so they're not jumping in. What's your take on in terms of the timing of equities and whether now is a good time to jump in?
Well, again, I look to history and I get a good sense that following down years in the market, instead of rising a little less than 10% on average, the market has gained 14%. And if you look to some of the indicators popularized by the Stock Traders Almanac that give an early warning signal for the full year, by that I mean the Santa Claus rally and the first 5 trading days of January, following negative years and those two positive indicators, the market has been up an average of 21.5% and higher 92% of the time. So I feel encouraged that we could end up being surprised by the market. And that's why we have a year-end target of 45.75 on the S&P 500.
Definitely on the more bullish side. We like to end on an optimistic note. A big thank you there. Sam Stovall there, CFRA Chief Investment Strategist, and Zachary Griffiths, CreditSights Senior Strategist. Thank you both for joining me this morning. All right, coming up, are you paying enough attention to the fiscal retrenchment trade? Our next guest says you probably should be. Find out why it impacts stocks like Boeing and Eli Lilly. That's all up next. A political powder keg. Now, stocks that are particularly sensitive to fiscal spending are bracing for an era of political gridlock. Meanwhile, China's reopening could see a boost in big brand US leisure and luxury. Well, joining us now with Global Insight is Ben Emmons, Senior Portfolio Manager and Head of Fixed Income and Macro at New Edge Wealth. Thank you for joining me this morning. So a lot of people, when we talk about Wall Street, we say Wall Street likes gridlock. It means no major policy shifts. But for those that are exposed for some of this large fiscal spending, I know you're looking at companies like Boeing, etc. How soon could we start seeing some of this really affecting their stocks?
Yes, thank you again for having us. Well, it could start as soon as now because, before the program, I was reading up on how many bills are being introduced by the Republican House. And it's all about trying to curb back spending. For example, about the IRS, they're trying to rescind that as one way of curbing the deficit. And the battles are starting now. And the president has said they will veto those bills. And of course, in the Senate, the Democrats hold the majority, so they'll not going to let that pass. But as a result, nothing gets through, nothing gets changed. And this will probably become an important factor driving the economy in the course of this year, as fiscal spending by itself was already being reduced over the course of last year and gets further retrenchment potentially. And then those companies that you highlight are quite sensitive to fiscal spending historically and over the last number of years. So I think the effects are coming through already, and you're seeing some of the stocks trading off a bit. And I think as more and more gridlock presents itself in the House and in the Senate and between Republicans and Democrats towards the president, I think the stock market is going to react to that.
And as we look at some of these big names, we've got Boeing, Eli Lilly, Moderna, Pfizer. Who is most exposed at this moment?
I think it's all of them all together because each one of them have sort of a, say, individual contract with the government, if you call it that way. I mean, you highlight here Pfizer. It's actually one name that works still really well because of the COVID pandemic and in demand for vaccines. But as we know, there has been financing of vaccine development from U.S. government, from other governments. So I think you could look at it not in an isolated way, but more like this basket. But I think what you really want to think of it is that if you analyze that basket and as it starts to quote unquote roll over, you can make it as an indicator to what's happening in Washington in terms of further gridlock on fiscal policy. And I think that matters.
And Ben, something that you cite that might soften what we might see in fiscal retrenchment and the Fed tightening is China reopening. How do we actually see that play out?
Yeah, that's a different development that is in a way positive. We're seeing it since late October that China has slowly signaled to start to reopen its economy, and then as of December, that accelerated the process. The impact is felt in materials and commodities, and particularly copper and metals. And from there, it's actually an impact on what I call the leisure, hospitality, and cyclical side of the economy. If China fully reopens its borders for tourism coming in and out of China, well, yeah, then airlines and hotels and all of those start to, again, trade up with momentum. And that's actually been happening, too. Since the start of this year, the S&P airline index is up almost 8%. So it shows you that China is being anticipated, the China reopening is being anticipated. I think that could somewhat offset that negative effect from this fiscal gridlock that's building in Washington. Overall, though, it's still to be seen how much one will offset the other, but it's at least a positive development starting in the year.
And certainly still a very tentative situation as we're sort of still wondering what's happening with the numbers there. And we're seeing an increasing number of countries adding testing requirements for Chinese tourists. I do want to ask you, though, about the China reopening basket, some of the companies you're watching there, including Nike, some of these companies with high China exposure. What sort of upside could you see there?
Yeah, you have to really think about that as China reopens. It is no longer going to disrupt the production process of companies like Nike or Tesla or Apple as much as it did before, because there will be no more lockdowns, or if there is any, it will be really sporadic potentially. So that's one way how these companies could benefit, at least having consistent production. Secondly, there will be obviously demand for these products from China. as people break out, just like here, I think the consumer reaction in China will be nothing different than what we've had experience as United States or in Europe. When people have been locked down, they come out, they spend. And there's also news out that also China will issue stimulus checks. So you can imagine that the demand for U.S. products, other products from other countries will pick up in addition to the China demand for commodities.
I think yes, because I think people forget that China has not had that pent-up demand spending spree that the rest of us who reopened a lot sooner have had. A good point indeed. Ben Emmons there, thank you for joining us, Senior Portfolio Manager and Head of Fixed Income and Macro at New Edge Wealth. Thanks so much. All right, well, let's take a closer look at news out of China. The nation ceasing to report daily COVID-19 data after it abruptly reversed course on its zero COVID policy. All this raising fears about international efforts to respond to new variants. Here with more, Yahoo Finance's Anjali Khemlani. Anjali?
That's right, Rochelle. Unfortunately, we know that with the repeal of the zero COVID policy, China has been under the spotlight and under the microscope once again globally in trying to track what is going on in the country. They first stopped reporting COVID cases and now are stopping the tally on COVID deaths. They're being called out by the World Health Organization, with Emergencies Program Director Mike Ryan saying that their deaths are heavily underreported, and that's a quote from China. And so that really remains a concern, as we know that what happens in China could then flow out in waves across the world. We know that right now the BF7 variant, one of the two dominant ones there, is still here in the U.S. We haven't seen it cause as much damage as it is right now in China with the overflowing of hospitals, but definitely something to watch.
And Anjali, staying with pharmaceuticals, Bayer and Google announcing a deal to help fast forward new drug and treatment research. Tell us more about that.
Yeah, so this is interesting. We're actually seeing this trend pop up a lot in the health sector where, tech companies are having a large say in helping with efficiencies with drug companies. So Bayer is one of them. We also know, for example, that Amazon Web Services has been a part of the process. Perfect example, Moderna's vaccine that relied on looking at the molecule buildup and what the correct formula could be for the vaccine. And that's where this tech comes in. The cloud computing power is now being used to help create a faster way to develop these formulas and identify what could be the most efficient. This takes away months to years of testing and R&D, and that's where this news is really interesting. So it definitely is an interesting race that's heating up right now between these two clouding megapowers.
Certainly tech just dropping into everything at the moment. A big thank you there, Anjali Khemlani. All right, coming up, walking the fiscal cliff edge. Inflation data is much more than just food and housing. School fees form a major part of the CPI basket. Our next guest tells us why this will matter more and more in the months to come. COVID battered college enrollment during the pandemic, wreaking havoc on funding as students delayed enrollment or opted to go directly into the workforce. Now, those institutions are also facing rising costs, with the higher education price index outpacing the consumer inflation by 2%. We're here to discuss the implications for colleges as well as the public school system is Marguerite Rosa, Director of Georgetown University's Edunomics Lab. Good to have you on the show, Marguerite. So we've been hearing a lot about this fiscal cliff, some of these funds that will be ending in 2024. What do people need to know about it and what that actually is going to do in terms of education?
Well, the so the federal government put a lot of relief funds into public schools starting in 2020 and again in another wave in 2021. And school districts have been making good use of those funds. They're spending altogether about $5 billion a month right now as part of the federal relief funds on all sorts of things, including pay raises for teachers. But that money ends abruptly September 2024. And it means that we have one more school year after this one where schools are propped up by these federal relief funds. And then we call it a fiscal cliff when schools have to adjust to a new and lower spending amount. And so if those funds have gone into pay raises or hiring new people or new programs or services, then schools will be struggling to make those cuts.
So then put that in context of what we saw in terms of how education fared with this latest CPI data and what that might perhaps spell ahead.
Right. So the CPI data. So as you know, we've had a bunch of months of inflation. In fact, many school districts saw that inflation and gave out larger than typical raises to teachers and bus drivers and food service workers and custodians and all the employees in the system. So really, in the end, labor is the biggest piece of public education. 80 to 90% of public education is labor. So when inflation goes up, the system wants to give raises to its employees. Well, those raises become the new permanent baseline. And when the funding disappears, there's still a commitment to maintain these raises. So that's what we're thinking is the largest effect. Inflation also affects what parents pay for when they, back to school costs. They buy supplies and notebooks and clothes and things like that. There's a transportation element. When you see oil, gas prices go up, then that can affect school districts. But really, the largest piece of this is the labor bill, because it's 80 to 90% of what this $700 billion industry is using its money for. So it's those raises that I think are the piece of this that make public education a bit precarious, not this next school year, but the year after.
And as we speak about public education, we did see during the pandemic, obviously a lot of school closures there. Private schools that perhaps didn't have as many restrictions saw an influx of some of those students. Tell us about what's happening in the public education space and what we might see going forward.
So it's really all comes together in what we're calling the fiscal cliff. It's a bit of a perfect storm for public education finances. So you have this federal relief money ending in a year. You've had all of this pressure for larger raises because of inflation, and add into it that school districts have lost some enrollment. And it's not just switches to private schools. It's some parents are homeschooling. Some have just migrated to different parts of the country. Some students have dropped out of high school early, and we have lower birth rates in this country right now. So we just have a decline in our student age population. But all of those enrollment declines, they add up to about, somewhere in the neighborhood of 1 to 3% of an adjustment. And for a school district, believe it or not, that is a large reduction. And so for a school district that it typically gets its money based on the number of kids it has, if it has many fewer kids in the next year or two, it means that school districts will have to start to right size their operations. And many of them, that may mean closing a school. That is about the hardest thing school districts can do, which is close a school, engage with their community, move students around. So we're likely expecting a lot of pain, dialogue, discussion when it comes to how to right-size districts and whether and which schools to close.
And what about when it comes to college enrollment? With college being so expensive, a lot of people chose to go into the workforce. Right now, you have very low unemployment rate. It's much easier for people to get a job than before. What does that mean in terms of college enrollment going forward?
Well, the enrollment declines across the board for student populations mean that K through 12 has fewer students. It also means that those enrollment declines ultimately mean fewer students in higher education. You're right that with more opportunities in the workforce right now, and whenever we see more opportunities in the workforce, then we see fewer students in college. There are more opportunities to get loans and funding from colleges. What we expect is that this will hurt the colleges kind of on the margin, those smaller colleges that can't afford to lose 5% of their students, not necessarily these large public universities or the most selective private universities, but the smaller regional public colleges and some of the smaller liberal arts private schools, private colleges that really can't sort of right size their finances with the loss of some students. So I think we're going to see a fewer number of colleges going forward.
And that certainly would be unfortunate. A big thank you there. Georgetown's Economics Lab Director, Marguerite Rosa. Thank you for joining me. All right, coming up, a leading indicator. One of Apple's major suppliers cuts capex for the year ahead on a weakening chip market. We'll take a closer look at numbers for TSMC and why it all matters for the economic road ahead. Shares of Taiwan Semiconductor up more than 6% after its chief executive said the company expects a further easing to the chip shortage that has hammered the automotive industry. Yahoo Finance's Dan Howley has the details. Dan, a little bit of bright news here.
Yeah, a little bit. Right now, they're saying that they still don't have enough wafers to meet demand, but they expect that to ease pretty quickly in the coming months. You know, the automotive industry obviously has been hammered with chip shortage. We've seen vehicles from various manufacturers sitting in lots just waiting for chips. Obviously, the whole issue during the pandemic with used cars was people wanted those because they already had the chips built in and new cars didn't, so used car prices skyrocketed. They've since come down and are continuing to come down, and we're seeing more chips available, but some companies still looking for those. But TSMC overall says that for the most recent quarter, they had a record gross margin of 62.2%. That's up from 52.7% a year ago. Their guidance was a little bit lighter than analysts had wanted, though. They are guiding for 16.7 billion to 17.5 billion in Q1. Analysts wanted 17.9 billion. And so what they're doing is they're trying to cut costs as far as CapEx goes to kind of make up for that decline that we're seeing in the chip market. Now, they're saying that obviously they're going to have a revenue decline in the mid to high single digits in the first half of the year. But then they basically, kind of poo-poo the competition like Intel, saying that, the other members of the industry will have problems throughout the whole year, but we're going to have some return to positive revenue in the back half of 2023. So they're essentially saying, look, we have enough products. We have this huge range of capabilities. We're going to be doing well. We'll have to see. The entire chip industry right now is clearly hurting. The pandemic saw supplies a shortage of supplies, in the first part of the pandemic because, companies didn't think people would buy anything. Oh, wow, people did want to buy things because they needed computers. So then we saw a huge ramp up. Now they're dealing with the leftovers from that ramp up. And so people at this point just don't need new computers. They don't need new devices that may or may not need these chips. And so these companies are just sitting with these chips at this point. PC makers, smartphone makers, they're dealing with the same exact thing. So we'll just have to see how this shakes out for the next year or so because, outside of TSMC with these kind of somewhat rosy predictions for the end of 2023. We have Intel, NVIDIA, and AMD also continuing to struggle as far as the chip market goes. So, it really is anyone's guess at this point.
And it's been tough timing what the consumer wants and being able to get it with these supply chain snafus as well. Dan Howley, thank you so much. Meanwhile, Amazon has lost its appeal to overturn the unionization of workers at its New York warehouse on Staten Island. For more on what this means for negotiations between the company and its workers, let's get to Yahoo Finance's Ali Garfinkel. So, Ali, a lot of people weren't sure if this was going to go through.
A lot of people weren't sure, Rochelle, but here we are, and this is a major loss for Amazon. What this essentially means, Rochelle, is that the Amazon labor union, this independent upstart union, has officially won certification from the NLRB, the country's labor regulator. And again, huge setback for Amazon because not only did they lose this appeal, not only did they fail to stop the Amazon labor union from being certified, the NLRB found that there was no credence to any of Amazon's objections to the election. Now, Amazon said it's ready to appeal yet again. However, over time, what experts are telling me is that we're going to start to see Amazon run out of options. For the Amazon labor union's part, we're seeing them say, yes, sit down with us. It's time to bargain. And a statement released by Chris Malls today says as much. Bottom line, over time, we're going to see this fight continue, but Amazon's options will continue to narrow. And we'll see where that leaves them in a year, Rochelle. Again, we didn't even know that they could win, that an independent union could win an election in an Amazon warehouse representing thousands of people. So this story is going to continue.
You have to wonder about the domino effect as other Amazon employees see this victory and wonder what that means for them. Yahoo Finance's Ali Garfinkel, thanks so much. All right, coming up, perception matters. Will signs of cooling inflation persuade American prices could be heading somewhere nearer to normality? Or will they still need to steep discounts to load up those online shopping carts? We'll discuss next. Investors aren't the only ones cheerful about slowing inflation. Online retailers combing through today's Consumer Price Index report for any sign of a recovering consumer. Here with a look at digital commerce, consumer spending, and a look back at retail over the 2022 holiday season, Kristen Gold, Rakuten Rewards President. Kristen, great to have you on the show. So you've said that 2023, Rakuten is saying that this is going to be the year for the reset for retail. Are we talking to pre-pandemic levels?
I think what's going to happen is that we've had a very dramatic few years in retail. It's been really disturbing, I think, for both consumers and retailers to understand what's going on in the industry. 2023 is going to be what we consider to be a return to normalcy. Retailers have a decent amount of inventory, but aren't over inventoried. Consumers are circumspect, but still spending. And I think what we're going to see is a little bit less drama and a little bit more of a flat line back to normal. Potentially not all the way back to pre-pandemic levels, because there is still looming recession, looming challenge in the economy. But I do think everything's going to calm down a little bit.
And consumers did spend over the holidays, not as much as retailers would have liked. How did Rakuten fare then if some of these retailers weren't doing as great?
Actually, on our platform, retailers fared very well. Consumers were really looking to cashback sites and to deal sites to gain a little bit of gain a little bit of momentum and gain a little bit of money back as they were shopping. So on our platform, retailers fared very well. And I think they were very pleased with their holiday season from our perspective. I think consumers spent, and consumers actually spent more over Black Friday and Cyber Monday than the retailers anticipated. They spent more over the entire week of Black Friday than we've seen in the past. So we had a record week, which was really lovely to see given the volatility over the last few years.
And we know people have been looking for deals. I love Rakuten. I'm always looking for a coupon or a deal. So that was definitely the place that I started. We know that it was also a challenging year for margins. What are your expectations for 2023?
I think margin is going to be the word of the year for retail. Effectively, a lot of these retailers had so much inventory coming out of the holiday season in 2022, they spent the entire year trying to liquidate it. And many retailers, honestly, were still liquidating that inventory all the way through the holiday peak. And they were really using Black Friday and Cyber Monday to finally get rid of that last gasp of pandemic inventory. They're going to be very focused on margin this year because a lot of them had to hit margin significantly harder than they would have liked to. Even the big marketplaces had huge challenges with margin all the way through the year. So if you look at where they're going to gain momentum again, they do want top line sales, but also they want to return to profitability and health. And I anticipate that that will really be what the retail industry is looking at and looking for. And frankly, what investors and stockholders are looking for from these retail companies is just how do you get out of this discount death spiral and how do you return to a place of normalcy and a place of margin health?
And that can be hard. Once people get used to discounts, especially as they brace for a recession, it could be hard. So what are some of the consumer trends that you're watching for this year?
It's going to be an interesting year for consumers. I do think the month of January will be very promotional still because it is typically the last month of a retailer's fiscal year. So they do like to squeeze in a lot of the discounting before their fiscal year ends. There are a few things that we're watching, though. I think there's this interesting component of luxury still continues to boom. Consumers are still buying a lot in the luxury space, and that really hasn't cooled through the pandemic. I think that will continue. Marketplaces really have been dominant and continue to dominate over the Q4 time period. I think that will continue this year. There are interesting micro trends happening, though, things like resale and resale becoming more important to a consumer's portfolio, where they're more willing to engage with resale companies like ThredUp and The RealReal instead of buying new. That's something definitely to watch in terms of sort of micro areas for growth in the industry.
And I want to ask you about conversion optimization. A lot of things can stop a consumer from hitting that final buy button at the end of the day. What sort of investment are you seeing in that space?
I think that honestly is what so many of our retailers are focused on right now. It used to be all about customer acquisition, and it used to be all about going out and buying customers, looking at Meta and looking at Google and going out and doing a lot of acquisition. Now, acquisition is incredibly expensive. So you really turn your sites as a retailer to how do I retain the people that I have? How do I create the journey that is really easy, that allows them to navigate my website and check out easily? Conversion optimization exists all the way from when someone comes into a website all the way through checkout. And I know even on our platform, that's something that is so important to us this year, which is just how are you maximizing every step of a consumer's journey and making it really frictionless and easy to shop. I know that retailers will be focused on that this year just because it's so expensive to go out and acquire new customers. So why not use the ones that you have and provide something better to them so that they do more with you?
Exactly. Make it easier for us to spend our money. Don't have it not be free shipping when we get all the way to the end. I can't stand that. But a big thank you there to Kristen Gold, Rakuten Rewards President. Thank you for joining me this morning. All right, coming up, Tesla's slump. Since its public listing almost 12 years ago, Tesla has built one of the most recognizable brands on the planet. But is the party over? We'll take a closer look. The details next. Now a programming note. Tomorrow we'll be taking a deep dive into Tesla's stock crash in our latest installment of What Just Happened, the show where we break down the top trending story from each week. Yahoo Finance's Pras Subramanian will help hash out the details, and Pras, no shortage of headlines when it comes to Tesla.
Yeah, Rochelle, this week's stock was kind of trading in a sort of mixed trading range here, but last year's when the stock really took a big hit. And a lot of that is because the stock is sort of tied to Elon Musk. We've talked about that a number of times. It was his soaring vision that brought Tesla to where it is, that sky-high valuation. And that now we're seeing a confluence of factors sort of hitting the stock. Of course, Musk's distraction with Twitter and also his sort of unending stock sales to finance that bid. We have a possible slowdown in China that's happening right now, and new competition from a lot of traditional automakers that once sort of belittled the EV trend. Now you're seeing GM, huge year coming up. You have Ford, continued momentum with the F-150 Lightning and also the Mach-E, and also VW ramping up with his ID models. And also VW qualifies for that IRA tax credit because they build those cars in Tennessee. So a lot of factors here at play for Tesla, and right now investors are hurting.
I mean, you have the company itself, and then you have the cult of personality that is Elon Musk. So definitely looking forward to that. Pras Subramanian, thank you so much. All right, well, let's do a final check of the markets to see how they're faring on this big CPI day today. We see they're picking up some gains right now. We see the Dow there up about 0.5%, 150 points roughly. The S&P 500, they're up 0.1%, up about, just about 4 points. Tech-heavy Nasdaq there, dragging at the back there, but still at least mildly in positive territory, up about 6 points. Well, that will do it for now. I'm Rochelle Akufo. I'll be back with Yahoo Finance tomorrow at 11 a.m. Eastern. See you then.